Good evening, ladies and gentlemen, and a very warm welcome to the MC Dezerv Wealth Summit. You know, never before have Indian investors had so many opportunities, so many products, and so much of access to capital markets enabled by, for example, new age platforms like Dezerv, which was founded just 4 years ago. Today India is home to 13.6 crore individual investors and more than 21 crore demat accounts, which is a testament to the scale and maturity our markets have achieved. Mutual funds alone account for 5.7 crore investors, and over the last decade, the industry's assets have grown sixfold to 80 lakh crore. And yet, only 1 in 10 of Indian households participate in equities or mutual funds. So there is a vast gap between potential and participation, and that really defines the opportunity for the rest of the decade and beyond. Beyond mutual funds, alternative investments such as private equity, venture capital, real estate, private credit now manage well over 12 lakh crores, offering sophisticated ways to allocate capital, which is based on risk and time horizons. But abundance creates a lot of complexity. We have 2,200 mutual fund schemes, and I think about 4,000 listed stocks. So, which is quite remarkable. So, making the right choice is no longer about access, but about understanding. This is where today's conversation becomes important. I think many of the fund managers, you manage large pools of money. You help investors, both retail and big and small. You advise them on how to allocate capital. So this is not just about investing. The pool of savings, which is ultimately powers India's real wealth creators, our businesses. It fuels expansion, innovation, and job creation, and is central to the vision of Viksit Bharat 2047. So that's why we have curated the summit. It is to help investors make informed decisions, deploy capital wisely, and build resilient personal wealth. And when investors do well, the nation prospers alongside them. So thank you once again. Thank you for taking time out on a Monday evening to make it here. This is, of course, a very optimistic take on what will happen in the next 4 or 5 years. If any of you have a more pessimistic take, feel free to spell that out as well. I mean, obviously, investing has lots of rewards potentially, but also risk. As I said, I think we have an impressive lineup of speakers this evening, and I'm sure they will cover all aspects of investing and of the magic and the joy and the perils and pitfalls of wealth allocation. So once again, thank you so much.
Thank you, Bodhi, for those inspiring words. Now let's start with the first conversation for the evening with an important subject, where all smart investing really starts: portfolio resilience. Volatility today is structural, not occasional, and that changes the investor's job. It's no longer about calling market turns, but about building portfolios that can endure uncertainty with discipline. In this fireside chat, we will explore how resilient portfolios are constructed, where conviction matters during stress, and what separates long-term platforms from short-term performers. To lead this conversation, please welcome on stage N. Mahalakshmi from Moneycontrol, and joining her is a leading voice in building disciplined, long-term investment portfolios. Please welcome Sandeep Jetwani, co-founder of Dezerv, with a big round of applause. The stage is all yours, ML.
Thank you so much, Nandita. It's an absolute delight to kickstart today's evening with a wonderful discussion point: building a stronger portfolio to outlast volatility. Looking at this room, I can't really figure out, how many people have been in this market, investing in this market for more than 25 years. But I remember my early days in journalism around 2000. I mean, it was not unusual for the main indices, Nifty and Sensex, to go up and down 3%. It was easy. A bad day was when the index fell 5%, a really bad day. And a day where the index actually fell 10% and trading had to be halted. So we've seen things like that. Today, it doesn't look like the markets are volatile at all, because at every selling, you see buying. Nevertheless, one of the aspects that most investors fear the most about equity markets is the fear of this up and down. How much ever we say that over the long term it gives you good returns, I think Indians have not experienced, except for the last 5-6 years, that this volatility or up and down is really worth investing in or buying into. But then the volatility, uncertainty, the fear, all of these are the very core foundation or attributes because of which equity markets thrive and give superior returns. So first thing I want to ask you, Sandeep, you've been a private banker, investor, now you have this investment wealth advisory firm, which you're building beautifully. What is your perception of how people think about volatility? What are some of the things that you, as an investor, as an individual investor, thought about, and how have you used that in, laying the foundation for how Dezerv goes out and tells the story of compounding?
Mahalakshmi, thanks so much for having us here. A part of the question's answer was in your question itself, but let me take a step back. The fact is that while investing, nobody really envisages volatility, right? And in some sense, volatility is the price that you pay for compounding, right? And when you think about the compounding formula, right, it's the amount that you invest, the return that you get, and the time that you invest for. And if you think about it, out of these, what's essentially in your control is not the return, which is where most of us focus our time and energy on. To some extent, it is the amount of capital, but that's guided by the amount of savings that we can have and what kind of spends do we have. But really, the only factor that's somewhat in our control is the time that you invest for. And when you think about the extent of time, let's say investing for 10 years, 15 years, where do bad decisions happen? It's at periods of extreme volatility. It's either when markets are doing exceptionally well, then we get carried away and overinvest, or when things are down, is when we tend to exit the markets prematurely. India has now, in the last few years, or at least for the last year and a half or so, seen another version of volatility, which is no return for an extended period of time. It's gone through a time correction, right? And these are times when people's sort of patience is being tested right now. We see a lot of clients, or even when people are reviewing their own portfolios, think about the fact that last 1 year, markets have given lesser return than fixed deposits, right? That's colloquially how people refer to the fact that their opportunity cost of investing has been high and that they've not been rewarded for it. I think in this period of time, there's really no solution other than wealth managers really handholding clients and talking and reminding clients about the longevity of the time for which they're investing, right? And how the fact that if you miss a certain number of days in the market, you actually miss most of the returns in the market. Because like you said, you don't know which day markets will be up, which day you will have that 5% rally, right? But staying invested is important. That said, it's not to say that equities is the only asset class that we need to make money out of, right? Fixed income has done reasonably well in India. Short-term rates are reasonably decent. Gold and silver also merit a reasonable allocation in the portfolio. We think up to 10% of the portfolio should be allocated there. And then there is international assets which merit some allocation, right? So it's that creating that overall portfolio that becomes really important. A lot of our time and attention is focused on the number which moves every day on the screen, which is the price of the Nifty or the price of gold. And sometimes those numbers going up and down draw too much attention, much more than we should give it.
You know, one point that I want to pick on that you said, which actually quite stunning, that you're saying clients are already asking you, or you see people asking, why should I invest in equities, because in the last 1 year you've had flat returns. And by the way, this year till date, it's not flat, we are up 9%. On the Nifty. Of course, people are hurting because in small caps and mid caps, you've seen far more serious falls. But in 1 year, people are asking you this question. Does it tell you something? Is everything that we've been talking about, is it going in vain? Is it one of that investor mania that we've seen for so many cycles that you see again?
Manashmi, the more things change, the more they stay the same, right? And I think it's relevant that people get worried about their portfolio not giving great returns. If you see, let's say, last 14, 15 months, and especially folks investing in individual stocks have seen a situation where while the index might seem flat, the median stock is down much more, right? Probably like down 18% if you think about the median Nifty 500 stock, right? And that's something that potentially worries a lot of people. Most of the portfolios were built in a time of markets were reasonably up. If you go back to 2020 and the troughs of 2020, and since then is when most people at home started investing, I think they saw that bit of a rally and then a little bit of stagnation and some down if you especially had direct stock portfolios. I think that right now it's not in that frame where people are exiting equity markets just yet. But certainly the sense of impatience is beginning to kick in. And that's again really where the role of the wealth manager or advisor comes in.
So what do you tell people who are asking you this question that, hey, last 1 year I haven't made money, should I switch back? What should I do? What is your answer?
I think first is our job as somebody who's trying to educate people about the markets is to de-link the orientation towards past performance. The assumption that the great returns of last year will get replicated or the negative returns of last year will get replicated into time in the future, right? So I think just walking everyone through that concept, that what has happened in the last 1 year is definitely not a reflection of what is going to happen in the next year or the couple of years after. In fact, almost certainly you'll get it wrong, because if the market has given 10% return the last year, it will not give 10%. It will either give 12, 15% or 7, 8% or negative. It will certainly not give exactly the same return. So you're sure to be wrong if you assume that that's the same return you're going to get. The second is, I think, to some extent, if you think about what kind of post-tax returns different asset classes are giving and walk everyone through that. While fixed deposits might be giving 7, 8% or 6, 7%, the post-tax returns on them are significantly lower than anything else that these clients will do over a long period of time. And then reorienting back to the fact that this is money for a certain period, that this is not capital that they might need in the near future. I think those are conversations that need to be had, which is why this entire process is more consultative rather than instructive and telling people that this is what you should do, but it's more like what do you collectively think together, both as a wealth manager and as the owner of the wealth.
Okay, I'm curious to understand this messaging a little better, also but for the benefit of this audience and a lot more people who are watching us on Money Control. Is, when we say post-tax, you are better off than debt, people tend to compare it or think about it like this year, like you started saying that this year we have just done as well as debt. But when you see a 25% drop in your portfolio, like small caps, you have seen that kind of cut, even in funds. What do you tell them? Because 25% cut means next 3 years debt returns is gone. So what is the message to that investor? And how do you shift this thinking? Of course, we say you can't look at it, but how do you explain to them?
I think, Mahalakshmi, courtesy of all the work that media platforms like yourselves have done, and in general the education that a lot of people in this room have contributed to, I think there is some appreciation of the fact that there are different asset classes. And the question is on how much to allocate to which asset class, right? Today, when we look across portfolios, we do find over-diversification. But at the same time, we are not seeing portfolios getting hyper concentrated towards small and mid caps, right? So the average portfolio, while like individual stocks have fallen that much, may not have suffered that much. So I think while there is downside, it's not as bad as what we might assume in 18-20%. Is that a kind of downside? Absolutely not, right? But I think clients are willing to engage, right? And if you think about the fact that these are not people investing for the very first time, the fact that in the last 4-5 years they've experienced some bit of volatility, sure they've made money, but there is openness on most clients' part. I think that's something that we hope that more people will exhibit, which is the fact that be willing to look at data, be willing to engage with data over a little bit of a longer period of time. And when you look at those numbers, it's not as bad as what looks in the short term.
Can you take us through some of the most common pitfalls in investor portfolios? What are the common mistakes that investors generally do? I mean, you've always said that it is not about bad products. Most people, the products are not bad, but it's just that they've over-diversified or it's not aligned to their goals. 2 or 3 thoughts there.
The first common problem that we see is reliance on past performance, is that we're making investments into selecting mutual funds, stocks, or even other asset classes on the assumption that the last 1 year return was great, and therefore these assets will continue to do as well in the future, right? So that is one part. The second part is over a period of time, as more people talk to you about investments and you hear about more stocks and individual mutual funds, you tend to get over-diversified. We have seen individual portfolios with maybe 70, 80 mutual funds and maybe 30, 40 stocks over, let's say, a portfolio of 1 to 2 crore rupees, right? And now that's clearly over-diversification that's happening. And the third is the tendency to churn or act on the portfolio more often than you should. There is, this F&O has been a big part of allocations for a lot of people who are spending time on the trading screen. And I think that has led to enough losses, and SEBI has also written about it. So I think those are 3 large areas. The first being reliance on past performance, the second being over-diversification, and the third being some trading activity that the portfolios have had.
Right. Are these also the same mistakes that, very rich people, family offices, businessmen also make? Because this is one cohort, last 3-4 years, there has been significant selling from promoters. A lot of that money also got rerouted into equity markets. And that money is also getting a little impatient now. That do they inherently feel that, if my business is valued so highly, I'm not so sure there is so much money left on the table in markets. And what do you tell them? What is the case for them?
Look, I think we believe wealth solves a lot of problems, but wealth also comes with a set of problems, which is the problem of choice, right? The moment you have, let's say, 50 crores, 100 crores plus, you have a situation where pretty much every asset class is within reach. And at that point, there is a tendency of evaluating things for the sake of novelty, right? We've seen this happen that some of the simpler investments, including mutual funds, potentially the most tax efficient, best governed, the allocation that such investments should have to large portfolios tends to go down. And there's an increasing allocation that happens to alternatives, in some cases individual investments. Now, when you think about individual investments, there is a concept of adverse selection, which is that when an idea comes to me and I'm a family office running, let's say, 100 crore portfolio, one of the questions at least should be asked is, why is this idea coming to me and why have institutional investors not gobbled it up? Because if you think about from a promoter standpoint or from a founder standpoint, they would want large single institutions in the cap table for most part, right? So I think those are the questions and the problems that family offices face, that because of choice, the allocation to exotics and alternatives becomes much higher, whereas sometimes the real opportunity is in plain sight, which is mutual funds and simpler investments.
Right. Tell us, what are you doing differently at Dezerv? Are there any products, features, things like that truly differentiate you? And I want to ask you another question, because this past performance should not be relied upon, is like, this eternal truth that has been spoken for many, many years, not only here in India, but US and everywhere else.
It's a standard disclaimer.
It just doesn't change, right? It doesn't change investor behavior. Now, my question to you is, as media, as agencies like, Morningstar or Value Research or, even even the industry, we continue to show 1 month, 3 months, 6 month, 1 year performance. Is there a need to completely, if you were to truly bring about this change in investor behavior, should all that be banned? Would it be an ideal world to have performance for equity funds be shown only 3 year onwards or whatever that time may be? I'm not sure. Some people these days recommend have 7 year holding period. So maybe 3 years, maybe 5 years. How will you as a wealth advisory platform react to it? How do you think the industry will take to it?
Lakshmi, the fact is that the moment you ban something, there is be greater attention to that, not less, right? And the way I think about it is that the NAVs are in the public domain. Pretty much everyone can figure out, even if I don't put it out there, what the 1 month, 3 month, 5 or 6 month return is. People will see it, right? I think it's more the education around the fact that that's not the only thing and that we should rely on. There are alternative data points that probably also need to be spoken about or written about. There is the concept of rolling return. And I know some industry participants have spoken about 3 year rolling return as being some of the data points that we should put out. Even that in itself is not sufficient, right? Because the assumption that that 3 year rolling return will replicate into the future is something that we shouldn't assume, right? And therefore, the way we think about it at Dezerv, and you spoke about what differentiates us, it's not about what investment solutions I offer, but how we run these investment solutions. Our thought process is that our selection should be more data-led, and the data should not only be past performance, right? Today, when you look at the macroeconomic situation, you can evaluate or assume that certain styles will do better, or certain styles of investing will do better, and within those styles, which are the individual fund managers or assets that we will have, is a function of the micro parameters of that particular asset. The reason we do this is because not only are we saying that data-led investing does better, in some sense, we are also getting out of the way. Because as wealth managers, as investment advisors, we are also human beings. We also have our biases. By making sure we have robust frameworks running portfolios, to a large extent, we can eliminate the bias. Can we fully eliminate human insight? Absolutely not. There needs to be a layer of check at the final stage. But largely it should be driven by data-led processes, and that's something that we strongly believe in. This informs everything that we do, whether we create mutual fund portfolios or portfolios of boutique fund managers or even other asset classes. This is something that's fundamental to us.
Right. Is there any one money mantra that you want to emphasize as a closing note?
I think
your own personal money mantra.
My personal money mantra is to make life as simple as possible. And I think
it's a life mantra.
I think it's a money mantra also, but I wish I could live it better. For me, most of my allocation is towards mutual funds, and to the point that some of us in the industry have access to some of the most exotic investments out there. But really, like I said, real return is lurking in plain sight.
So what does simple mean in mutual funds? Sorry, I'll take 1 more minute.
When I say simple, I think
index funds.
No, I'll come to that. And we have a view on that as well. But 7 to 8 mutual funds pretty much, but actively looked after, gives you pretty much everything that you need in the markets. When it comes to index versus active managers, honestly, we are not in a camp. There are times when we believe active management does better, such as these. And there are times when it's easier to hold the index and keep the cost low. So I think it's about being objective and thinking about at that point of time what is right for the portfolio. But really 7 to 8 mutual funds should be good for 70 to 80% of the portfolio.
All right. On that note, thank you so much, Sandeep. Such a pleasure talking
Thank you,
to
Mahalakshmi. It's been a pleasure.
Thank you so much, Sandeep, for those invaluable insights, and thanks, Mahalakshmi, as well. We now turn to a question many investors are asking, often quietly. Is Indian equity still the default choice? Indian equities have built wealth across cycles, corrections, and crises. For years, they've been the natural home for capital, almost by instinct. But 2025 has unsettled that comfort. Returns have been uneven, valuations remain elevated, and capital has begun to look elsewhere towards gold, fixed income, global equities, and alternatives. For the first time in a while, investors are not just asking what to buy. Where does real diversification begin? And with more choices than ever before, how should portfolios actually be allocated today? That's the discussion we bring to the stage now. To guide the conversation, please welcome back on stage N. Mahalakshmi. And joining her on the stage are Aparna Karnik, Head Quantitative Investments and Analytics, QIA, DSP Mutual Fund, Siddharth Bhaiya, MD and CIO Equitis, Abhishek Tiwari, CEO, PGIM India AMC, and Saurabh Mukherjee, Founder and CIO, Marcellus Investment Managers.
Thank you, Nandita. So like Nandita pointed out, I think this year it is like Indian equities on one side and everything else on the other side. Gold, silver, international equities, even real estate in parts. Everything has done well except Indian equities. And today, even if you look at market valuations, which we obsess over, the index valuations, even though a lot of you will tell us that that's not the number to focus on, you need to sort of go a little deeper. It looks like India is just the same as US. Nifty is probably about 20 and a half times trailing earnings. S&P 500, NASDAQ will be about 21, 22 times trailing earnings. It looks like, everything is the same. And taking off from what Sandeep said and what all of us have learned, it's a bad idea to just look at the rear view mirror and invest for the next year, right? So looking at last year, what is your inference? Let's start with Aparna.
So, he rightly pointed to the fact that, we should not look at recent past performance. But as an anchor, I think it's worthwhile to look at long-term historical averages. So while last year, Indian equities generally had a bout of underperformance. But if we go back in time, like 5 years, 10-year averages, we find that most of the asset classes tend to have, so if you look at Indian equities, 5-year, 10-year, we have seen returns of 15%, 14, 15%. If we see small cap equities, they have been 1 or 2% more. If we look at US equities, they have roughly been the same as domestic equities, and Indian equities and US equities have generally been one of the best performing asset classes for a variety of reasons, depth of the markets, institutional frameworks, very strong political stabilities and so on and so forth, good capital allocation. So like there's a reason why those returns have, have been generated in the past. Going below that, if you look at gold, for example, it's also been around 13-14% in INR. If you look, at international markets, so if you look at European markets, they have given maybe 12-13% in INR terms. And if you go to emerging markets, most of them have given sub 10%, sub 8%, so quite low returns, single-digit returns. So while it's easy to get like a bit frustrated, he alluded to, that last year returns have been not so good, or they haven't underperformed other asset classes. But if you look at the slightly longer picture, you see that they haven't really, they've delivered very good wealth for investors, and some of that mean reversion has happened. So look at, even now, small caps, if you look at a 3-year, 5-year kind of returns are like 17, 18, 20%, So really, why are we getting too much bogged down by the last 1 year? It's a mean reversion. These things happen. So therefore, what I feel is, like the way we look at it is, we need to have a balanced view going little bit beyond the very recent past and anchor to long-term averages. And there is a role for all asset classes in the portfolio, right? You need equities for growth. You need fixed income for some protection in a recession or slowdown. You need gold and silver for an inflationary environment. And you need to have some defensive assets which can protect you when things are uncertain and volatile, So that is how we feel one should look at a portfolio approach rather than either getting too swayed or too frustrated by returns.
Your message largely is don't look at last year. If you look at the longer time period, all assets have pretty much done, all risk assets have pretty much done the same. So why upset anything? Go with whatever with a
balanced view and a diversified portfolio. And there is a place for each of the asset classes. So there is no need to be trying to, so I would like to rephrase the question more like instead of this or that, and, this and that, instead of trying to predict, just be prepared, via proper portfolio allocation.
And is important also because I think exposure to global equities in Indian portfolio is non-existent. Of course, Indian equities itself is only a recent phenomena, but global equities is non-existent. So, Siddharth, let me come to you. Is there something structural you see that is good or bad for Indian markets? Because we've thought about this as a very long-term structural bull market, a long-term structural growth story. I don't know whether I should say bull market because that is also to do with valuations. And you have said for the longest time that we are in an overvalued zone. A lot of people have said it, but you showed it in action by holding cash.
I think we are in a bubble of epic proportions.
Sorry?
We are in a bubble of epic proportions.
We are in India, in India, all over the world?
In India, in some parts of the world as well. Okay, we did an analysis. All this 20p multiple is all, bullshit. If your portfolio
20p on the Nifty.
Nifty. The 20p in Nifty, a lot of it is because of SBI, ONGC, NTPC, Coal India, Power Grid. Nobody has that in their portfolio. So excluding that, Nifty P is more than 40. Okay, you go to mid caps, you go to small caps, P multiples are in excess of 50. What does 50p mean? 50p means that, so first and foremost, we have to get returns right. If a stock goes from 100 to 150, the returns are not 50. It's an outcome. Okay? Return is the inverse of P multiple. If you buy a stock at 4p multiple, then you're expecting it to get your capital back in 4 years. So typically your return expectation is 25%. If you're buying a stock at 50p multiple, your return expectation is only 2%. And what happens in a 250p environment? The promoter comes and sells. So I've said this a lot in private. I'm going to say this in public. It is not SIP. It is SWT. It is systematic wealth transfer from India's middle class to the rich. The SIP amount has been matched with promoter offloading. Okay, and everybody is out here. There's just one reason why I've been off media for the last 1 year. And I was warned by my team that please control your emotions today. So what I'm seeing is not a healthy bull market. It's not a healthy capital market. Okay, we have been peddling this story of India growth story for the last 18 months. Everybody cribs about last 1 year returns because maximum money came in the last 18 months. Everybody talks about asset allocation. You talked about asset allocation. 25 years of investing. When a bull market comes or a bear market comes, your asset allocation is thrown out of the window. Sandeep, you work with families, right? You guys work with the best of families. What was their allocation to small and mid caps 5 years back, and what is it right now? So I won't take a lot of time because there are other this, but all I want to say is,
we are in a bubble of epic proportions.
Be careful. Be careful. Don't listen to narratives. Go back, look at your portfolio. What is the PE multiple of the stocks in your portfolio? And forget the growth story. I can tell you, Mahalakshmi has got vintage. Go back and see how many IPOs came between 1991 and 95. 5,000. Maybe another 10,000 would come since then. How many stocks are listed on NSE? 3,000. What happened to the rest of them? Corporate governance issues. Forget growth. They all sold you promises of growth, and behind that, the stocks got delisted after some time. So, yeah, that's my...
Thanks. I'm going to come to you with a couple of follow-up questions, but before we do that, Saurabh, is there something structural to what has happened to the markets this year? Is this 9% growth that we've seen, it's not negative. We've seen some heavy lifting from large cap stocks. Banks have done reasonably well. Is this just some sort of moderation in performance which you see is going to maybe a year more will turn, or is there something more that you worry? He's saying bubble of epic proportion. Where are you?
So I'm a Bengali, right? And we are prone to, as you might know, Bengalis are prone to intellectualizing. So my wife is my check and balance. So 3 years ago, I was, doing a Siddharth at the dinner table. And my wife said, when are our children going to go to study abroad? And I said, well, wo to 2025, 26, 27, 28 hoga. And she said, will we have enough dollars to finance their education? So I said, pata nahi, it's looking overvalued. Quality of accounting is also going down the doghouse. She said, don't give me that BS. Figure out a way so that our future is sorted. Right? She said, kuch to tu kar. Don't come and tell me overvalued market hai. Quality of accounting niche ja rahi hai. Promoters and cashing. I was doing a Siddharth because that's all I know, yaar. That's right. So, I had to think on my feet, right? And I think Siddharth and I have known each other for a long time. I've known many of you in this room. I don't think any of us are saying stuff that is unknown. So I told her, look, we'll have to invest outside India. She said, do whatever is necessary. Figure out a way to invest in high quality companies wherever they are in the world. Nobody's tying you down to India. So I flew to New York. Found a good team, got a license there, built a fund there, came back to India, persuaded the powers that be in our country that we should be allowed to do this. And credit to our authorities, credit to Gift City. All of us in this room, nobody's compelling us to invest here. We can diversify across the world. And taking Siddharth's point forward, right? It's a free market. The data is available to all of us. So let's look at the data. Siddharth already gave you super piece of data. Promoters and private equity are selling every day. The second piece of data, look at the bond market. Look at AA and single A spreads. For the last 2 years, AA and single A spreads are giving you a message that bond investors are saying that Indian spreads need to go up. Prices are coming down. Right? I think last 3 weeks, 3 high-profile PSU bond issuances didn't get off the ground because the market said, or yield chahiye or spread chahiye. So the bond market is flashing a pretty clear signal. And thirdly, look at data on corporate earnings, right? So Nifty 50 EPS growth. It's remarkable actually. Nifty 50 EPS growth, probably you'd think the most basic piece of data. You'd notice most brokerages have stopped publishing Nifty 50 EPS growth for the last 8 quarters, maybe 10. Nifty 50 EPS growth in our country is, last I knew, is running at low single digits for the last 8 quarters, right? And Mahalakshmi, you highlighted that India and America, S&P and Nifty are trading at broadly the same forward PE. They are. Just that America ka EPS growth, rupee terms, mein US S&P 500 EPS growth would be mid-teens, and ours is low single digits, right? So earnings growth, bond market, promoter exits, the data is there for all of us to see, and to give credit to the people who run our markets. They're giving us the opportunity to globally diversify, tax efficiently at low cost. There's plenty of bargains to be had in markets around the world. Siddharth is investing in some of them. I'm investing in some of them. And, all I can say is, hopefully those who are watching here or online, join all of us in the global ride, because that's what investing is about. Diversify across high quality assets. India has had a good few years. Other markets will have a good few years. India will have another good few years. So different markets will perform at different points in time. It's a good thing actually if all markets performed at the same time and all of them went down together. Tab to rona jayega, right? Remember, right? Just think about it. If all markets did well together and all markets did badly together, that would be a disaster, right? None of us would really have a job. I suspect even high-class wealth managers like Mr. Jethwani wouldn't have a job if सब कुछ एक साथ चढ़े और सब कुछ एक साथ गिरे. The beauty of markets is different markets do well at different points in time, and that's why it's tremendous. I think it's awesome that India and America's stock market correlation is at its 20-year low. I think India-China stock market correlation भी, I think बहुत low है. So diversify across markets with low correlation, and you and I will be all right. But if you choose to say एक ही market में पैसा डालते रहेंगे, then I think the definition of madness is doing the same thing again and again and expecting a different outcome like the previous cycle.
Okay, I'll come back again. So it is one thing to say that you need to have a diversified portfolio because you have, like you started out saying that you're planning for your kids' education, which is a dollar outflow, so there is a need, and especially after looking at this year, 5.5% depreciation in the rupee, you definitely want to diversify and look at dollar assets. But quite another thing to say that, well, Indian equities are overvalued and it's not going to make money. So they're two different things. So Abhishek, your shot on this.
Hi. Okay, thank you. Thanks, Mahalakshmi. If I got the question right, I think what you're talking about is whether the overvaluation as stated for India in context to the global perspective. So I think
I'm saying all of them, he said we are, Siddharth has said we are in a bubble. Aparna said, hey, don't look at 1 year, look at long-term performance. All assets look the same, so stay the course.
Okay.
He is saying, I have a need to invest in dollar assets, it's well poised, so let's look there. What's your take? Are you saying Indian markets will underperform?
Okay, so let's break it down first of all. And I think numbers give you the fairest idea of where we are, while there are stories beyond numbers. And I think everybody else here manages money, so they are better equipped with handling those stories. But let me talk numbers. See, if you were to take a data point starting 2018 and not 2020, Indian markets have practically given a return which is very, very close to how the EPS has moved, right? If you move the data point to 2020, it is even closer because what has happened is cyclicals in the benchmark have actually got very exacerbated kind of an earnings. If I was to put numbers, 2018 to 23, large caps grew earnings at 11%. The returns for large caps is exactly 11%, right? The story changed in 23, 24, and it is normalizing as we talk, right? Now, there are obviously reasons to be worried about beyond just the top line indexes. But having said that, last year itself, as we stand, I think the Indian markets have delivered earnings and returns very much in line with each other, right? So the challenge is to say that are the answers in aggregates or are the answers in individual sectors and hence individual stocks, which you have to look at bottom up. If you look at it that way, I think there are opportunities. At least we feel, from a PGIM level, there are enough and more opportunities in certain sectors and very much certain companies. But let's, again, take another data point and say, which portfolio are you talking about? Are you talking about a global portfolio or are you talking about a domestic portfolio which has global diversification? If you're really talking about a global portfolio, then I think your answers still lie in very much markets like US, maybe cyclical markets like China, maybe other very isolated markets, but there are opportunities in Korea. There are possibly opportunities in Brazil as well. So if you think of it from a global dominant portfolio perspective, larger opportunities in US, very much strong opportunities in India with volatility, and then very, very secular opportunities in countries like Korea, Brazil, and so on and so forth. If you're talking about India-dominated portfolios, which are talking about the global diversification, then I think the yardstick to use is what is your use case? If it is only diversification, 10%, 15%. If you really have a use case of saying, you know what, I will shift over a period of time, or my children, are going to shift and they have to be educated, then that number could be anything. But again, even there, I don't think the answers any longer lie in aggregates. It is more about bottom-up specific sectors. Like, for example, AI, your leadership will be very, very concentrated. You talk about mobility, your leadership will be very, very concentrated. You talk about health tech, your leadership is very, very concentrated and it's geographically, moving elsewhere. So I would say, Mahalakshmi, unfortunately, there's no single answer to it. I think the answer is in the and, as Aparna was talking about. And, if you add more metrics to it, then I think precious metals, because the whole aspect is if you are talking with central banks being politically driven, and you are talking about fiscal policy-driven inflation taking the center stage, I don't think you can survive without really hedging yourself to precious metals.
Fair enough. Siddharth, let me come back to you. So, since you said in India we are in an epic bubble, where outside do you see opportunity? Because there is this a tug of war of sorts, or a debate going on everywhere in the world about this AI trade, right? Is it a bubble? Is it not a bubble? There are investors arguing that all the companies which are investing in AI today are all cash-generating companies. And by the way, Buffett himself bought Google.
He bought it at 13 times, 14 times earnings probably.
Right. So, fair enough. So, my question is not, I'm sure there might be some pockets of overvaluation like there is always in the market. But if this were to untangle or unwind, what kind of impact do you think it'll have globally, especially because US is really the foundational market for this, right? Where does that leave us?
So Mahalakshmi, every 25 years, you have a technological innovation. Last one was internet, 1999, okay? Before that, there were airlines, automobiles, there were telegraph companies in the 1880s. You had railroads before that, There were 100 automobile companies in the US in the 1920s. So every 25 years, there's a big innovation that drives and propels humanity forward. Okay, so if you think that an iPhone is a great innovation, it is not. It would probably not even come within the top 100, 200 innovations of all times. Okay, so coming to this, yes, AI is the future. Is it a bubble? Historically, if I've studied more than 300 years of stock markets, it has all the characteristics of a bubble. A lot of capital getting poured in, extremely high valuations, right? A lot of frenzy. Where's the youth investing? People who don't have experience, probably. So like any other you're going to have a boom bust cycle over here as well, and there's going to be winners out of it eventually. And yes, AI is the future. From our perspective, look, you don't have to invest in more than 50 stocks at max, so you can conveniently ignore them.
So you invest in global stocks but ignore AI, and you don't.
Yes, we are value investors. So we've launched a global fund 3 months back, and we found a lot of value in Europe. Right, we found value in US as well, but in the consumer space. Right, you have some of the biggest consumer names in the world available at single-digit P multiple, cash on the balance sheet, 5-6% dollar dividend yield. Right, any day I'm going to buy those stocks. Right, because I understand those companies, I use their products, right? So, yeah, for me, it's just about finding value, ignoring the narrative. And history has proven it time and again that every single time you overpay for an asset in search of growth, you will not just end up having subpar returns, you will end up having loss of capital. It's there. People talk about, Buffett invested in Apple. But he invested at 14 times earnings. He invested in Google, but probably 15, 16 times, I don't know.
No, it's a higher
No,
than
but
that
before
for
that,
sure. It's not 15
it came in September quarter, but his buying was probably June, July. It came within our global screeners.
245 is his average price, but whatever, yeah, I got your point. So, so you're saying even if there were to be some sort of an accident with the AI space, you will stand insulated in US markets as long as you are avoiding those stocks. Is that the premise?
No, look, that's very far-fetched to say. When you have 2001, when you have global financial crisis, nothing gets spared, correct? But you're giving yourself, it's like going and saying, I'm going to face Mitchell Stark. You want to go up completely padded with your helmets and everything in place. The chances of you not, maybe he'll definitely take you out, but you'll not get retired hurt for life. So that's about investing.
The reason I'm asking this question, and it is perhaps important for people to understand, is when you're looking at a bubble-like situation, like the US, if it unwinds, you see like a 30% drawdown. That's hard. But as far as we know about Indian markets, the flows keep it supported. So if it is a bubble, so be it. It might take unwind over next 5 years or 7 years. That doesn't give you a heart attack. You invest in US markets, assets go down 30-40%, it gives you a heart attack.
See, again, as I said, in both cases, we're talking about the future, right? The premise that retail investors are going to keep on investing for the next 5 years, right? I don't know, it could stop next month. See, that's future. That doesn't involve margin of safety. If your only call, some very learned person said 2 things will decide 2026. One is the supply of paper, and second is whether retail will keep on putting money into it. I said, that's just tell me that, and I know everything. Because those are the only 2 things on which the market is. There's no fundamental, you have to talk fundamentals. Is there margin of safety? People have forgotten the concept of investing. It is gambling. It is gambling. Let me put it this way. Everybody talks about time in the markets. Most mutual funds have a churn ratio of more than 100%. So where's the time in the markets? I have seen mutual funds with 500% churn ratio. Are you hedge funds or mutual funds? Correct? Time is when you hold stocks for 10 years, which we have done. Time in the markets is when you hold stocks for 10 years.
Fair enough. Aparna, where do you, you run a global value fund, right?
So we run, I run at DSP, we have 2 funds, both of which are having a combination of domestic. So one is a multi-asset fund, so it has pretty much all the assets. And the other has a combination of domestic and global equities, roughly in a 2/3, 1/3 proportion.
And you're,
at
you're
DSP,
more bullish about that?
So see, I mean, sometimes like a lot of things, are the boring stuff is the more real stuff, So, coming from like what point, he made that AI is a bubble, okay? So it's, every day, so the point is that we don't really know if it's in a bubble or not. I don't think that the verdict is in yet. And like they say, history, it doesn't repeat, it rhymes.
Right.
Okay, and there's a very big difference. And the amount of times people are talking bubble, bubble, bubble itself probably means
that there
it
is
could
no bubble.
mean that there is no bubble, because everybody is just worried about bubble, bubble. And if you see, there are similarities and there are differences. So I don't think the writing is on the wall yet. I think pretty much we'll have to see, time will tell. So our approach is to, look for basically growth at reasonable price. So we don't want to, given that, like he said, we are in the middle of a technological change. So even when you're looking at certain assets which look cheap on paper, but if their businesses are going to get disrupted or, there is no growth, it may not be a great idea to pile the entire portfolio into those assets. So we would like to try and have a mix of assets. Right. Some assets, maybe we think could benefit from the AI theme. So we have those kind of assets also across geographies. Then there are some consumer assets or beaten down stocks also. So like you have a combination of a barbell approach where you have some growth assets which you believe, could benefit if this whole AI technological revolution plays out, which it could. And then you have a bunch of assets where maybe you see some more deep value, which could benefit simply by re-rating. So we have a combination of assets. And even within India, like we have assets, some sectors we believe are expensive, maybe in the, say, capital, some of the capital goods stocks or, some of the consumer stocks could be considered as being very, very overvalued. But there are pockets where we believe you can pick and choose your spots. So we have that in the portfolio as well.
Sure. Quickly, just in one sentence, Saurabh, what is your, what is the tactical bet you would vote for this year?
So look, I think Harry Markowitz wrote a paper in 1952 for which he got a Nobel Prize in 1990. So he made it easy for all of us. We don't have to reinvent the wheel. What Harry Markowitz said was diversify across low correlation assets, Ideally, when you buy that asset, when you diversify into that low correlation asset, the asset should be sensibly valued. So in my coming up to 50 years of doing this, I've found
That rules out everything today then.
right? That gives
They're
us
all
three
highly correlated.
three low correlation assets, Mahalakshmi. First is Indian equities with American equities. There's very little to do with between America and India. The links have all broken down. And whatever's left, I think Donald Trump is trying to chop that and get rid of it. So India and America, low correlation. India and gold, reasonably low correlation. America and gold, silver, reasonably low correlation. So combination of our market, their market, and precious metals would be ideal. But the challenge is precious metals is expensive today, and hence I would wait to do that precious metals volatile diversification. But to stay in one market and believe that one market will take you to the promised land, I think that sort of sounds a little insane to me.
Abhishek, you can have the last word.
Sorry.
Last word on tactical allocation for this year.
Okay, so I'll possibly Saurabh has already explained it, but I'll take possibly a different yardstick. I think Siddharth talked about knowing how much of paper supply would come in and whether there's enough money to subscribe to it. I would add a little bit of top down. I would say if you are aware about where geopolitical risk is going, combined to the fact where the technological and innovation is happening, that could set your tone for a little medium to longer term. In the short term, if you can precisely, agree on how much supply and how much money is there, then I think you are sorted. So very honestly telling you, Mahalakshmi, I don't think we have an answer. So if you understand long-term trends, stick to your asset allocation, get into a product which is designed to benefit out of it. See, the challenge is we have a lot of narratives, but we have very less products designed to exactly go through with that narrative. So I think selecting that will be far more important rather than trying to, navigate through so many of different narratives is what I would say.
Thank you. On that note, that's all we have time for. Thank you so much, Saurabh, Abhishek, Siddharth, Apani.
Thank you, everyone, for framing those allocation choices with such clarity. Requesting Mahalakshmi to stay back on stage for the next conversation as well. Moving on, alpha has become harder to find, not because opportunities don't exist, but because dispersion has collapsed and valuations leave little margin for error. The easy trades are gone. Passive has crowded the index, and active managers are being forced to rethink how and when they outperform. So how do you chase alpha in a market that refuses to trend? To decode this, please welcome our panelists, Niket Shah, CIO, Motilal Oswal Asset Management, Chirag Setalwad, Head of Equities, HDFC Mutual Fund, and Ashish Gupta, CIO of Axis Mutual Fund. A huge round of applause for them, please.
Such a joy to host this panel, more so because this is the first time Chirag is coming for one of our mutual fund summits. So double thank you to Chirag, and of course thanks to Ashish and Niket. So you heard what the earlier panel discussion was. Two imponderables, unknowns. Will money flow into equity, continue to flow into equity markets? What is going to be the supply of paper this year? Will these two questions really...
So I think there are a few ways to think about it. I think the SIP flows, we all know this 30,000 crores comes in every month. I think there is some risk that can come down. Now keep in mind, it used to be 5 years ago, this used to be 5,000 crores, now it is 25,000 crores. So I don't see why there can't be some drawdown from this 30,000 crore number. I think that's point one. But I think the more relevant point is there is a significant accumulated SIP book. And if you see a 10-15% redemption of the accumulated SIP book, that could take care of sort of 4, 5, 6 months of inflows, which you see on a regular basis of this 25,000 odd crores. So I think you could see pressure on both sides. You could see the SIP number itself coming down, and you could also see the accumulated book facing some redemption. Now the 30,000 crores doesn't have to come to 10,000 crores to set off panic, right? You could just see the 30 coming down to 25 and showing a trend even further downwards, and that itself can create a lot of unease. So I think both of those things Could happen. Will they happen? Nobody knows, but they could happen.
So what kind of probability will you assign to that?
I mean, if we had answers to these kind of questions, we'd be geniuses and we'd be...
Come on, this is probability.
Trillionaires. I think...
As fund managers, you think probabilities all the time.
Well, I'll put it this way. The money that has come in from, I don't think, the strongest hands. The money has come in from individuals who are typically younger in age, who have shorter time horizons, and who've not withstood a falling market. So if you ask me, yes, there is a reasonable probability. What is that in terms of a pinpointed number? I don't have. But can this market see a correction of inflows or an outflows? Certainly it can. Is that high probability, low probability? I don't think it's low probability. I'm not clear whether it's high or not, but I would say there's a reasonable risk of that transpiring.
Ashish, do you see that as a reasonable probability risk, the risk of flows? You didn't answer the supply of paper question, but we can come back to that. Ashish, that question too.
Yeah. So I think, frankly, what I've seen over the last couple of years and way most of the mutual funds have been sold. Again, it depends whether the investor has bought them with the same expectation or not. But the way most of the distributors have sold the mutual fund has been more of an asset allocation trade. And what has been very, I think, comforting is the trend in SIP flows has been very steady, right? And now we have had, as you spoke about in earlier sessions, we have had 12 months of volatility, right? So you may say that for 12-month market has given a single-digit return, or if you look at 18 months, market return is negative. But actually, if you see over the 12 or 18 months, there have been bouts of volatility, right? So I think from October to March, we had about 16% drawdown in the market. Then we had a recovery, then another 5-7% drawdown in the market. And where we have seen really volatility is in the lump sum flow. So the total net inflow into equity mutual funds has varied over this 18-month period. The number has been between 25 to 45,000 crores, right? And the SIP flow has actually been steady. It's actually inched up from about 21,000 to 29,000 crores. So I think the SIP flow bit is actually been very steady, and I believe that is a more structural allocation. But yes, if the market has deep corrections, lump sum certainly stops and there can be redemptions. So I would be looking at lump sum being the volatile part, and that can drive volatility. But as long as the SIP piece continues at this steady state, I think market has less reason to worry.
Right. Niket, you can start with the supply question. So this year itself was record IPOs, I think 1.65 lakh crore or something, some such figure, close to that. Next year is estimated at 2.25 lakh crore, is that correct?
Yeah.
So that level of paper, will it keep secondary markets depressed?
Yeah, I think if you look at last year was 3 lakh crores, we're already touching close to 2 lakh crores right now. And an interesting stat is that if you look at last one and a half year data, stocks, almost 70% of the stocks are below the day one listed price.
Correct.
Right? Which obviously shows you the fact that playing the IPO market is not easier. Right? It's quite tougher. Unless and until you really get that balance 30% right, then you have really killed it. Otherwise, frankly speaking, it's very, very difficult to make money on the newer IPOs. But I think obviously, if I have to look at within our own house, if there's a company today which makes a profit of 1,000 crores growing at 25%, half of the room is filled. There's a company which is loss-making, promises to give you 3,000-4,000 crores, full houses, full. In fact, there is a need for extra chair. Right? So some of these new startups, when they come, they're great, exciting businesses. Looks pretty cool. But the fact of the matter is to make unit economics work is going to be very, very difficult. Right? So there's clearly, I would think, some exuberance in that side of the market. But I think over a period of time, we have seen enough and more that the market course corrects. If the flow slows down, people will stop applying to IPOs. If the IPOs don't perform, people become selective, or people will start for a far more lower multiple. And so market will kind of adjust to itself based on some mistakes that people will make over a period of time. So market will adjust for itself. But I would think that obviously the supply of paper is not slowing down anytime in the near future. The demand side has to slow down for the supply to stop. The supply will keep happening till the time your asset base keeps growing higher. The supply will keep coming. There are enough and more promoters willing to sell. In fact, of the 2 lakh crore, almost 60% is OFS, right? So, in fact, that is not money that is coming back to for some growth capital or for some capex capital in India, right? That money is being taken by private equity guys back home.
Okay. Same question to you. Do you think the supply of paper keeps secondary markets, a cap on secondary market performance?
I think, of course, it does, because there is significant amount of capital which is getting pushed into the primary market. Yeah. So thank God for that, right? Because if it didn't go into the primary market, it would all come into the secondary market, and the stupidity which already was persisting would have become even more exaggerated. So of course it puts a cap when you have $20-30 billion every year which gets sucked out of the market through IPOs. But that's, as Decode pointed out, it's a tough market. It's not that IPOs are easy to make money off. The ones you want to invest in are very well priced, and the ones you don't want to invest in are well priced. So it's a little bit of a sticky situation. But certainly the primary market does put a cap on the secondary market performance.
Do you agree? Does this push us into a slightly longer spell of mediocre or underperformance? This primary market pipeline?
So it does, but I think rather than kind of repeat what both Chirag and Decode said, let me give the other perspective, right? So, and I've written about the demand and supply of equities, but supply as a risk to the market should be seen as a risk in terms of the return expectation, right? But supply as a trigger for a crisis in the market should not be seen as a risk, right? Because again, go back 12 months ago, right? So markets corrected from, I think, November, October last year, and October to February markets corrected sharply. And if you see in the month of March, there was not a single IPO, right? So by definition, if the market's correct, right, the supply itself comes down, right? And the only other point I'd like to make is that let's not think about supply just in terms of the IPOs, right? That is only one part of the supply. And you spoke about the fact that this year we have seen about 160,000 crores of IPOs. But if you see the secondary stake sales, whether it's come from promoters, private equity, that number is actually twice that, right? So actually, if you add the total primary plus secondary supply, the number is close to $60 billion or so. It's almost 5.5 lakh crores. And again, the pipeline for next year is larger, both in terms of IPO, but even in terms of secondary stake. So 91 IPOs happened last year. This year, about 100 IPOs will happen. And all these pre-IPO investors who were logged in, their lock-ins also expire, right? So the potential supply next year will certainly be higher. But again, for that supply to come to the market...
The markets have to be buoyant.
Yes.
True that. Chirag, one of the points that Decode pointed out is that, about IPOs not doing too well. You said that it's a good thing that IPOs are coming, otherwise you will have an asset bubble in the secondary market. How do you navigate this IPO space? Because if it's going to be buoyant, and let us assume that there is no big drawdown in the secondary market, so everything comes crashing and the IPO markets also stall, given a status quo, kind of market, how do you navigate the IPO space? Because one of the things I myself noticed was, there is so much divergence in the performance of IPOs. Ola versus Ather. Right? Brainbees has gone down so substantially. Look at Meesho or LG, which has done so superbly well. So you can look at a lot of names that were buzzing, and you can pick out stocks that have gone down 50%. You can also pick out stocks that have gone up 50%. How do you navigate the space?
I mean, you navigate the primary market in a sense similar to the secondary market, right? You still have to do your homework. You still have to look at valuations. You still have to look at business models. You still have to understand managements, right? I think the only difference is that in the primary market, the amount of information available may not, or the history of information available is not as robust. But you got to pick and choose individual companies, right? And it's not easy because for the good issues, there is so much excitement and there is so much buzz and there's so much, we use this word narrative around it. And hence those issues, subsequently fail or don't do as well as per expectation. So I think you just have to focus on company by company and don't get carried away when there is a lot of excitement, right? We've seen lots of issues where everybody's jumping on board and then the returns are mediocre. But there are those issues which just about go through, 2-3 times subscribed, and those tend to do better. So I think focus on the fundamentals and I think clear the noise of the flows and the excitement and the grey market price and all of that stuff, right? You have to, I think, focus that this is not just an IPO which you're going to hold for, a short period of time, but something you would like to hold for 3, 5, 10 years. I think the challenge in IPOs is also that the good IPOs list at a pop. So the IPO price itself is only partly relevant because as mutual funds, you don't get meaningful allocation at the IPO price. So you really have to look at the listing price. And now if you list at 30, 40, 50% pops, then it becomes kind of irrelevant for us. So I think the listing price is as important as the IPO price.
That point again, sorry.
In the IPO itself, at the IPO,
because you don't get
you get
much.
a small allocation.
Yeah.
So at what price? Otherwise, you can't build up a position. So it's important that companies also don't list at sort of excessive valuations.
Right. Ashish, on this point, especially on new age companies, right, which is where I think there is a lot of ambiguity. There are companies which may have genuine track record, more stable businesses. It's much more easier to evaluate. But this new age companies, do you think it's all luck?
Actually,
because I don't seem to find a trend because it is the same, SBI mutual fund and HDFC mutual fund and GIC and all of these people setting the price. And yet, across so many IPOs, there is so much divergence in performance. So what is it?
So as Chirag also mentioned, right, so really for us, it's the point is not to just look at the performance on or look at the price or the valuation at which the IPO is coming, right? Because literally there is no significant amount of investment that we can do at that valuation. Really, in many of these companies, liquidity events actually happen mostly 30 to 90 days after listing, right? So when a lot of IPO lock-ins expire and pre-IPO investors come and say. And actually, when you start seeing that, and I think Niket mentioned that some of them have seen huge correction post the listing date, right? And that's where we would really like to evaluate, because that's only when we can build sizable positions into these companies. I think in terms of the divergence in performance, I think that challenge comes from the fact that lot of retail interest in these is built on because these are actually very consumer-facing businesses, right? So it's not necessarily just because of what is the financial domain, but retail interest could be because they are consumer-facing businesses and there is kind of hype around these businesses, or it could just be the fact that there are a lot of people, particularly on the HNI side, who invest looking at the grey market premium. And really, I don't know what is the liquidity of that grey market, right? So it is like the tail wagging the dog. So I think if you avoid those two barometers for evaluating how an IPO is, I think you can evaluate them like any other company. And I think it's hold true for whether it's IPO of a new age company or the traditional company.
Chirag, back to you, because both of you said that it's not. Don't look at the IPO price. Look at this listing day price because you don't get much allocation. Why is there so much hue and cry about anchor allocation? Too little, too much fighting for too little, that doesn't make it any difference?
There is fighting over allocation, obviously, because there are some issues which are high quality, whereas mutual fund institutions, we'd like to get a larger allocation, right? And there's only that much to be handed about. And hence, we get less than what we want. So if you want 100 and you get 20, what happens when the price lists at a 20, 30, 40, 50% pop? That 20% is not meaningful enough, right? So you, in a sense, become almost a forced seller because it has to be meaningful. It's no use having 0.01% of your portfolio in an IPO stock. So as a result, the starting of allocation matters, right? If you can start off with a 0.5% or a 1%, which I think rarely ever happens, but then you have a holding which you can comfortably hold for a long period of time. So I think that's why we're all, trying to get the right allocation.
Cool. So, Niket, going into 2026, where would your incremental flows go? I mean, is there a priority order in terms of the kind of IPOs you're looking forward to, or any pockets in the secondary market that you're really excited about? Excited in the sense, to the extent you can be excited about.
I think it's very tough to find value in this market. And I think to that reason, we have almost now 20% plus cash. So that's obviously a big challenge in this market. But I think there's only one space where I can find value, which is tech right now. It's completely beaten down. Valuations are reasonable. Rupees obviously in favor. So I would think, if I had to answer, tech is only sector which I would think of. But otherwise, I think breadth will meaningfully correct in next couple. Say if you take 12 to 18 month period, you will see index where it is, but the underlying breadth will continue to become extremely bad.
Sorry, the underlying?
The underlying breadth of the market will continue to worsen from here.
Okay, so your top bet is tech. Okay, anything else?
That's it. There's nothing else.
Only tech.
There's no value in the market.
If you have the option, you'll put all your personal money in your tech fund.
For sure.
All right. Okay. Ashish?
So, I think there are other pockets that do offer value. In addition, there are a lot of pockets which are actually seeing growth picking up next year. So for example, again, one of my favorite sectors, financial, is seeing growth picking up next year. There were some concerns on asset quality this year. That is also kind of fading away. NBFCs are also kind of likely to see a pickup in growth. There are sectors like insurance which have underperformed for a long period of time. So there are some affirmative regulatory actions that are also coming through there. So that is another space. I think in the earlier panel you spoke about the fact that earnings recovery is coming through next year. So there are pockets in which this earnings recovery will be more visible than. So I would say that there are opportunities. Of course, I will agree with Niket that value is tough to find. I agree that median multiple in the market is well north of the 20 times, which is the average Nifty multiple. So you have to be careful for what you pay for that growth. Right? But I would not be as concentrated.
So you're saying financials and consumer broadly?
Yeah, consumer, discretionary, financials.
So between you two, you've already picked, I
Both
think,
the
more
big
than 50% of the market. So yeah, you can go for the next 50.
No, I think, let me just point out a broader observation. I think it's interesting. The last panel also, most of the panelists were nervous, right? This panel also, it seems that most people are nervous. And I think that's good news. We've been concerned on the market. A lot of us have been concerned on the market for the last year and a half. And if you come to the same conference last year, and the year before, and the year before, everybody was bullish, right? And now for the first time, you're seeing a mixed room. And for the first time today, I'm seeing a room which is more bearish than it is bullish. So I think that's good news. The problem is that valuations are not reflecting it fully enough. After a 3 year fantastic bull market, we've had a 1 year correction, and we're already incredibly nervous about it. So I wouldn't be surprised if that volatility, correction, lackluster market behavior continues for some time until we weed out more of the excess. Mid caps, small caps are still 20-30% premium to their average. Large caps are at a 10% premium to their average. We have to first get to average, and we may even get to below average. So I think the journey can be a difficult one, certainly. But in that difficult journey and in a market which is flat or a market which is correcting, there are always stock-specific opportunities, right? But it is difficult when you're creating a portfolio of 50 companies to identify 50 opportunities in a market which is elevated, right? You can identify, 2, 3, 5, 10, 15, but it's difficult to get 50. I think this is a very stock-specific business. I don't think any particular pocket stands out as being very, very interesting. Yes, financials, valuations are decent, but it's not screaming, right? I think IT valuations are reasonable, but again, it's not screaming out. And again, within IT, there are those companies which are expensive, those which are cheap, same thing in financials. So I think you got to pick and choose and use that volatility. I think volatility, whether we like it or not, is going to be here for some time. And we have to take advantage of it, right? This is the only market in the world where we get nervous when prices go down. And if prices go down, if you're a long-term investor, it's a fantastic opportunity, right? I'm seeing a crowd which is essentially despondent, right, after a year of no returns. I think incrementally we will get more excited as this correction continues.
Right. One last question. If you were to curate a portfolio which will invest only in IPOs versus something that will invest only in secondary markets, at the end of 2026, which portfolio do you think will do better? Because I'm asking this question because it looks like next year, if we flatline in the secondary markets, IPO will be, in news and buzzing through the year. I don't know for the right or wrong reason, but
I would prefer the primary market, the secondary market, but for a different reason. It's, I think that some of the businesses which are coming up are also new age businesses where we are typically not comfortable. So that's one set which we're not happy to participate in. There are those companies where there is so much excitement that the valuations are very full. Again, that's a segment that we don't want to participate in. I think the secondary market is a lot easier to understand. There's a lot more history. There's a lot more data that you can work with. So I would prefer, I think 1 year is too difficult to say what will do better, but I would prefer in general secondary markets to primary markets.
What you?
I would also agree with Chirag. There's one deal launch every day right now. For last 365 days, one deal launch. Either there's a QIB, there's a block, or there's an IPO, right? Frankly speaking, the time required to even study a particular company is too less right now, right? So we are following an elimination strategy that what you don't want to buy, figure out first, and whatever is left is essentially what you spend time on. So I would think, I completely agree with Chirag, there is better history. You've time traveled with that company. You've seen cycles with that company. So I would go with the secondary market. Primary market, frankly speaking, if you read DRHP of companies and the way they open on day one, you just can't make sense of it, right? Some of the new age companies, just go and read DRHP. There's tons of information in DRHP. And sometimes I wonder that, there is, when it opens up 50%, 60%, I kind of figure out that, how does it work, right? But I think at the end of the day, you know that over a period of time, as and when reality comes to life, some of these stocks will course correct.
Right. So I'm really tempted to ask this question. We're running out of time, but you can have the closing remarks on this. So the counter to what Chirag said and Niket Shah said, a lot of investors argue, is that today you look at the Nifty 50, right? It doesn't look like the index of the future. There is so much fatigue in this. They are not new age businesses. We don't have any presence in AI. Forget about that. That may be a bubble. But even otherwise, it doesn't give you a feeling that these are businesses of the next few years. They are business models of the future. They are AI ready, digital ready, whatever it is. And this year's IPO, in a sense, will be dominated by that cohort. Just thinking about this particular aspect, can you articulate your view?
Yep. So I think that is true, but even if we look in the secondary market, right, because of what has come to the market in the last 3 or 4 years, there are enough new age companies. So there are fintech companies that are listed, there are consumer tech companies that are listed, there are health tech companies that are listed. So it's not that in the secondary market we are totally devoid of these. They may not be in the Nifty 50, but they are available for us to pick outside the Nifty. So I don't think finding new age businesses per se is a challenge in the secondary market. The real problem is a new age business at a reasonable valuation, right? I think the challenge is that's today not available in the primary market or the secondary market. So.
Sure. On that note, thank you so much, all three of you. This was a very enlightening discussion. Thank you so much. Thanks.
Thank you to all our esteemed panelists for that incisive take on where alpha might still be found. And thanks, ML, once again. We now shift from identifying alpha to capturing it. Tactical portfolios don't just survive volatility, they use it through structured flexibility, disciplined decision-making, and the ability to adjust as market conditions change. This isn't about market timing, but about knowing when to lean in, when to step back, and how to execute with clarity and control. Now, in this session, we'll look at how tactical allocation works today, where technology helps, and why disciplined judgment still matters. Joining me is someone who works closely at the intersection of strategy, technology, and execution to help investors translate conviction into timely, disciplined portfolio decisions. Please put your hands together for Vaibhav Podwal, co-founder of Dezerv.
Yeah. Is it working now? Yeah. Yeah, so I was saying a lot of interesting insights, a lot of nervousness in the room, a lot of contrasting viewpoints, so makes our job even more difficult to manage clients' portfolios.
I think it's not working. I think the mic got nervous.
Yeah.
So yes, let's start this discussion. You've had a fairly interesting journey, right? You started out as a chartered accountant, right, and developed deep expertise in asset allocation, portfolio management, etc. And then you went on and co-founded Dezerv, right? Tell me, what are those early lessons that stuck with you and that help you when it comes to portfolio building, especially portfolios that could ride changes in market cycles? Take us through what those early lessons were and how they really helped shape your journey at Dezerv as well.
So I started my career in 2010. So 2010 to 2013, the decade was fairly exciting. I started my journey when markets were just about to take off for a period of 5 years. The first bump that I experienced was in 2004 when NDA government lost election and in a single day market corrected by 11%. So obviously that was unimaginable. Then GFC happened in 2008, preceded by a spectacular bull run in Indian markets. And after global financial crisis from 5 years, zero market returns were there. Economic cycle changed from growing economy, 7.5, 8% growth rate to 4-5% GDP growth. Inflation went up from 4-5% to double-digit numbers. So all of these economic cycles, market cycles played out in front of me. So a few very interesting and important learnings which I accumulated during that period. First thing is portfolio should be treated as a system, not as a collection of securities. See, most of the time we treat portfolio as a collection of securities. We buy multiple instruments, multiple asset classes, and as a result of whatever is built, whatever is built becomes our portfolio. Portfolio is a system which ensures that your capital is protected, you are growing your wealth, and at the same time you are able to stay invested in your portfolio for a long period of time. These are extremely important considerations. Securities will come, go, change. Securities in this and asset classes also becomes irrelevant sometimes. So these were some important learnings. So for example, during 2007, everyone simply wanted to invest in equity. So equity exposure for the clients went up to 150% of their net worth. They borrowed money to invest in equity. So obviously you're compromising with the system. System has to outlast you. So these are some of the learnings which I accumulated during that period.
But now it's diametrically opposite, right? Because this year hasn't really been about equities. It's been about asset classes like gold and silver. Silver hitting 2 lakhs on MCX and gold, of course, shining bright as it is. So how do you really make your decision as to, where the allocation should be higher in such a scenario? In terms of equities as well, at least this cycle, how would you go about constructing a portfolio now?
So there are two parts to the portfolio. One part of the portfolio is your core portfolio, which remains intact for a long period of time. You make smaller tweaks in the portfolio based on your life situation, your net worth situation. Otherwise, large part of that portfolio remains intact. On the margin, you keep making tactical changes. So, interestingly, you brought up gold and silver. Last 6 months, we would have received more calls about investing in gold and silver than about equity. So, this clearly shows that we get highly influenced by recent performance of the asset classes. And that's the biggest mistake that we make. At the peak of any cycle, it's very difficult to make a distinction between skill and luck. A lot of investors who invested in gold and silver over last 24 to 36 months are attributing it to luck. A lot of investors who invested in equity in 2006-07 started attributing that to skill. So obviously, a lot of these elements are blurred, so we need to be mindful of that. On a tactical front, you have to have allocation to asset classes which provide stability to your core. And your core remains asset classes which you want to hold on for a long period of time, which would include domestic equity, which would include your global equity, some allocation to fixed income, and tactically, based on the changes in the economic cycle, you make adjustment in the portfolio to account for allocation to asset classes like gold, silver, and real estate. So that's how I would think about the portfolio, core part and tactical part. Never disturb the core.
Sure, never disrupt the core. So how do you really make decisions in terms of, allocation? In fact, if you talk about the market, the equity market itself, there's been a divergence there as well, right? On one hand, you've had benchmark indices hitting record highs, but there has been clear pain in the broader end of the markets. Some stocks have come off 30-40% from their record highs, right? So that's the kind of pain we've seen. So dichotomy there as well, right? So how do you decide, when to stay the course, which stocks to add, which ones to get rid of? Because you guys at Dezerv follow a data-driven, systematic approach, right? So how does all that come together?
So three things we look at very closely. First, valuations. Value and price may not always operate in sync. Valuations can go up and down, price can remain static, or price may go up and down and valuation may remain static. So you have to look at valuations, not the price. If price of the stock is moving in tandem with the growth in earning, then you are on the right track. But if price of the stock is moving regardless of the earning growth, then there is an issue. And some of the correction which has happened in the market has happened because people built in crazy growth expectations in the prices of some of these stocks. And that's why some correction is taking place. So obviously you need to look at what kind of valuation divergence is there in the stock. Across the spectrum, if there are 500 stocks in the benchmark, you look at what kind of valuation divergence is there. Based on their historical earnings, based on the peer set, you look at what kind of disconnect is there. Then you look at behavior aspect. Overcrowded trades will always correct. Crowding of the trade is something that we look at very closely. Number of shareholders which are increasing is something that we look at very closely. So that is another indicator. Third is behavioral aspect. Whether there is an extreme enthusiasm about a certain narrative or a certain theme, then that is something that we stay away from. So these are some of the ways in which we can distill the data.
In the current market scenario.
Sorry?
Can you give us some examples?
I think recently, 21-22, everyone wanted to invest in startups. My society had 5 angel investors clubs, so that was clearly a case of over-enthusiasm around certain asset classes. Last year, we saw over-enthusiasm around defense and PSU stocks. So some of these pockets keep popping up in the market, and you need to be mindful of staying mindful about these pockets and stay away from them as much as possible.
All right. In terms of mutual funds as well, one may have exposure to 20 mutual funds. But, when do you decide that, or how do you really pick mutual funds? Because then there is a risk of over-diversification as well. Or else you're chasing, certain themes. So how should one decide and, do a health check on their portfolio accordingly?
So 2007-8, I learned an important lesson, which is lack of permanence in the market. no theme, no sector, no fund manager, no style will work across market cycles. The best performing fund manager of 2007 is not managing money anymore, right? Had the worst performing fund in 2008. Worst performing funds of 2007 were the best performing funds in 2008, 9, 10. Most popular themes in 2006 to 2007 was infra and capital goods. It took them 10 to 15 years to come out of that bad cycle. So it's important that you understand that these cycles will play out in the market and look at macro indicators like change in the regime, economic regime which is happening, to guide you on which kind of style of investing and which sectors and what theme of investing is likely to do well in the future versus looking at how these fund managers, themes and sectors have done in the past. Few things which are completely important for us is we never invest in thematic funds. We stay away from that because themes go through abrupt cycles and these cycles can end very, very quickly. Second, we never participate in NFOs. We don't invest in more than 6 to 7 funds. Active share in the fund is an important consideration for us. We believe that fund managers should have our portfolio should have an ability to generate alpha, and that will only come if we have a reasonable amount of active share in the portfolio. Valuations of the funds, lot of funds which are receiving large amount of cash flows or flows because the performance has been very good, end up getting into this bubble valuation territory. So we need to be mindful of. There are multiple data points. So we analyze more than 2 million data points on a monthly basis to arrive at what mutual funds to select for the fresh cash flows which are coming our way from the investors.
So when you divide a portfolio between core and tactical, what are the pointers you keep in mind when you're looking at the tactical side of it?
So core allocation, I'll use equity as an example. Typically, it will be diversified funds across large cap, mid cap, small caps. And on the tactical side, on equity, we will do some adjustment in terms of change in the market cap allocation, which is needed for that market. So in case we want to go overweight on mid and small caps, then we'll increase allocation there. In case we want to increase allocation to large cap, we will increase allocation there. On the asset allocation front, core remains based on whatever the strategic allocation that the investor has defined, where adjusted for the risk, they are getting adequately rewarded. See, the problem is we misunderstand the risk. It's not a linear graph where increase in risk will always mean increase in returns. Risk, beyond a point, increases disproportionately higher than the returns. So we have to be mindful that we are not increasing risk disproportionately. So we cushion our portfolios with allocation to precious metals. REIT and InvIT has become an interesting asset class for us, which gives cushion to our portfolios. So tactically, within asset class, we look at opportunities to go overweight or underweight a particular segment. Across portfolio, we look at underweight and overweight position across various asset classes.
Sure. Of course, if you had to, bet on that one big shift that will, change how we invest over the next 5 years, what would it be?
So there are three things which are important in investing. First, you need to have significant, or traditionally the way alpha has been described by the fund manager, the sources have been two. Information edge, you have superior information compared to someone else. You can capitalize on that and generate returns. You have analytical edge. You can analyze information better, and that can also contribute to substantial amount of return. Fortunately, unfortunately, information is available equally to everyone now. Analytical edge also, with the advent of AI and all the systems that we have developed for investment management, analytical edge is also not there. What will make the biggest difference is your ability to stay disciplined in the market and follow the core principles of investing. I think whether it is for next 5 years, 10 years or 20 years, the biggest differentiator would be your ability to stay disciplined. So you're living in an era of instant gratification. If you keep searching for instant gratification, then obviously investing will not work out. And a lot of technological advancement has happened in investing also. But it has also made investing very convenient. So exits happen very fast. So investors' ability to stay invested is also getting compromised because of that.
Sure. So what is that one thing that one should keep in mind, if a stock say, is not doing well consistently. But you are convinced that, this is a theme that will do well. So, how, does one really stay the course in such a situation?
Think probabilistically. Create a portfolio which takes into consideration all the probabilities and takes into consideration all the possible outcomes which are there.
Sure.
If you don't take that into consideration, then disappointment can be fairly large.
All right. I think with that we've timed out. Thank you. Thanks a lot.
Thanks
for
a lot.
into perspective.
Yeah.
It was lovely chatting with you.
Thank you.
Thank you. Well, moving on, the Indian mutual fund industry has reached scale with record assets under management and steady disciplined inflows driven by SIPs. Investor participation has deepened and commitment has stayed consistent. But scale alone doesn't guarantee outperformance. That is the real test ahead, as preferences shift from pure equity to hybrids, active to passive, and domestic to global exposure. 2026 will challenge fund houses on strategy, distribution, and performance discipline. This panel looks at how the industry adapts next. To guide this discussion, please welcome back on stage N. Mahalakshmi. And joining her are three leaders who run some of India's largest and fastest growing fund houses. Managers India, Kalpen Parekh, MD and CEO, DSP Mutual Fund, and Sid Swaminathan, MD and CEO, Jio BlackRock Mutual Fund. A big round of applause.
Thanks so much, Nandita. There is no doubt about the fact that mutual funds have clearly become the household savings vehicle of choice, which is a big, big thing that I've heard for 25 years as I track the industry, and finally it has happened. But I think what is more interesting and a big win is that mutual funds today are not just about equity, debt, etc. It straddles the entire risk spectrum, and it expands now into real estate through REITs and long short strategies. I don't think it was thinkable that under the mutual fund framework we would have long short strategies even 2-3 years ago. Right, so the number of products and categories, the way they are increasing, is definitely wonderful. Not only because you have a milieu of products, because the framework of mutual funds in terms of disclosure norms, transparency, so much regulatory scrutiny, and the discipline that the players have sort of demonstrated over the years makes it the perfect platform. But the thing that we will discuss right now is 2026, because whatever we say, investors chase performance. It is a given. And it's a message we continue to sort of deliver to the investor, that don't go only by past performance. But there is a lot of push also from the industry in terms of what categories you go into, what is the, what are some of the challenger brands, how do they challenge the market with new products, innovations, and so on. And that's what we should be discussing today, because that will shape 2026 outcomes equally, as even if investors continue to make the mistake of looking at past performance and investing. So Kalpen, what does the 2026 playbook look like from a strategy, category perspective?
So I'll start by saying that investors don't chase past performance. Human beings chase past performance, and consumers chase past performance. Those who have evolved to become investors understand that investing is about cycles. They understand that returns and markets will fluctuate, styles will fluctuate, asset classes will fluctuate. So I think over time, few consumers are able to migrate and become investors. And that is called learning from markets and experience and building that wisdom. But
Let's say novice investors and accomplished investors.
I won't even say that, because there are enough investors who after 30 years also do the same. Which is where I think it's about...
Which is why they have to keep investing.
Yeah, and which is where there is volatility, and which is why there is risk premium. Otherwise, the day equity starts giving stable annual returns of 12 to 14%, it will become a fixed deposit, and it will earn the returns of a fixed deposit. The risk premium will go away. And wise investors want to harness or exploit that volatility to earn that risk premium. So I think it's very clear, those who want to be genuinely investors should acknowledge that it is not a straight line. And if it is not a straight line, then you rather know when not to enter and don't mistime it. So I think the playbook of misbehavior of human beings, and this is not, I'm not saying that people on the other side do that. Even we make these errors. And which is why I said human beings make these errors. And whether in fund managers or in investors, there are good fund managers, there are not so good fund managers. There are good investors, there are not so good investors. The right investors learn from cycles.
So you're just politely saying even fund houses make mistakes. So
you are making me say...
Instead of broadening it and saying, human beings make mistakes, you can say industry players also make these mistakes.
You want to
fund
make
houses
this...
Also
you want to
mistakes.
make the panel more
that's
interesting.
What you meant,
No, I didn't mean it. You are very senior to me and I always respect you. So I'm a bit nervous.
What makes you think so? That's not true?
No, my point is the debate is not about what fund managers do or what investors do. The debate is how can we earn better returns. And ultimately, that is the progress that we want from every year. So if we can learn from mistakes of not chasing past returns, not chasing hot asset classes, Weber made some very interesting points that, how do you judge where are we in the cycle? So I think 2026 will be a combination of, most investors chasing what has done very well. Last year, 2025, the flow to gold and silver was almost like less than 5,000 crores or maybe less than 2,000 crores. This year, it has gone up to 35, 40,000 crores. And every meeting that we do is about gold and silver. Last year, thematic funds had 1,35,000 crores of flows, which is a lot of NFOs and, hot products. This year, that number has dropped to 25,000 crores.
Yeah.
So that's a big shift. People are saying, okay, equity, so I think this does not change. This playbook does not change, whether it was 98 when I started my career and tech funds got a lot of money, or it is 2026. So I think this playbook will not change, but through dialogues and conversations like this, if we are able to make small shifts every year, equally heartening is the fact that this year multi-asset funds have become 35,000 crores in flow. Flexi-cap funds have grown almost 80% in flow, which is a bread and butter category. So that's a great sign that some investors are saying, let me not get into this large cap, mid cap, small cap, thematic, growth, value, momentum, so many labels, but focus on a core flexi-cap strategy. Focus on, diversification through multi-asset. So I think there are good signs and the bad signs will continue. I am a cynic in that context, that for cycles to happen, misbehavior has to happen. And there will be few investors every year who will graduate and migrate to become better investors.
Okay. By playbook, I actually meant from a fund house perspective, what is your strategy and thrust for the year? We'll come back to that.
Sure.
Sid, you can take a shot at that.
Yeah, so you want me to answer
So how many funds do you have now? You've rolled out, the fastest rollout we have seen in fund houses is
We've just closed fund number 10 in the first 5 months. So in terms of the playbook, and I'll link it to some of the themes as well. I think asset allocation starts becoming much more of a talked about topic amongst a lot more investors next year. So, and we heard this in the previous panel as well, right? So really thinking about what are the core exposures, what are the satellite exposures. We're already starting to see that come through from the investing population. And our rollout has reflected a bit of that. So even the first 10 funds that we launched, we're trying to hit, cash, core equities, have some satellite exposures like small cap, mid cap available as well, and then arbitrage more recently as well. So I think that's a theme that we want to follow. So we want to build kind of the suite of offerings that become available. Again, you just mentioned new categories emerging with derivatives enabled. So I think we'll be having a look at that as well. International exposures you talked about. I think that's, again, one that is becoming more and more recognized as a true diversifier to portfolios. So then we're looking at, how can we make that, accessible? So for us, with the digital model that we have, it's all about how easily can we make it accessible to the people. So and I think that's one that we still need to crack. But these are kind of the big themes, asset allocation, differentiated strategies, and international exposures, in my mind.
Fair enough. Your take, Swaroop?
From a 2026 perspective?
Yes.
Yeah, I think we just gave out our yearly view, and I have a very, very philosophical view on 2026. It's like if you...
It is a good time. End of 2025 should make all of us philosophical.
Yeah, but when you look at what's happened at the underlying, and here's my personal opinion, that it's like, you've played the first evening of a cricket match, and towards the end, bad light has ended it, and overnight there has been rain, and next day when you come to bat, that is 2026, all the rules have changed. When you look at the rules of the asset class and what we call the democratization of bias is what will unfold in 2026. And I dare say all portfolio allocation rules that existed till today might not have any correlation to what you will do from 2026. That is what is the dramatic underlying impact of what has happened.
Sorry, repeat that.
Yeah, that's a good question now. Let me get warmed up.
This needs to be internalized.
Okay, so when you have the largest economy of the world changing behavior, the rest of the world changes behavior. I don't know whether equity will happen or not next year, but I know for sure that sovereign will continue to buy gold till the polarity of the world exists. So this entire thing of gold being a hedge, and I'm not linking it to returns, I'm just talking about portfolio allocation, that gold being a hedge to equity stands completely dismantled. On such podiums, if I would have said equity is a growth asset class, I would be right. But I didn't say that. I put my gyan and said equity is the only growth asset class. On 10-year, when gold is outperforming equity handsomely, everything that I stood for on such podiums are already dismantled. So this myth of growth being core or whatever is gone. You have to relook that, number one. Number two, when you look at that equity allocation, and you talk about core, I think we talked about core in the last panel, core being large cap heavy, flexi cap heavy, in the recent public issues being more on mid and small, purely on catching the length and breadth of the market needs to be relooked again. Right? And the third, of course, if the interest rates remain this for the next 5 years, India will have other problems to assess. Rarely are you sitting on this incredible position as an investor where all asset classes look very different and favorable to you, but the rules of asset allocation have changed completely. So if you don't do that, you will be the return chaser which you were. And unfortunately, I think it's even worse in 2025 than when we started our careers. And see, we are getting our money. We're getting 25, 26,000 every month, the industry. Most of the AMCs are growing. Market is also getting net money. Market is also growing. Unfortunately, the investor is exiting. My humble request is you can exit, but write that NAV that you exit and compare it to the NAV of the same fund 5 years later. If you are buying small caps so confidently 2 years back, why are you not buying the same fund at a better price today? Leave the problems to the fund manager. People are becoming fund managers over fund managers.
Yeah.
Right. So the point I'm making is
fund of funds.
Yeah, if you remain sane, the opportunities of allocation are bright in front of you, but the rules are changing. Hence, I think your approach to portfolio allocation in that review of 2026 Jan has to be looked very refreshingly or in a very fresh sort of approach is the point I'm making.
Okay, so I'll take one point because that's quite dramatic, that should you be looking at gold as a hedge versus a growth asset class? Because for years and years, this is what we have, in fact, even now, I think the conversation around gold is still, it is insurance and hedge for, geopolitical uncertainty, hedge against the dollar, and so on and so forth. Nobody talks about gold as a growth asset class. First of all, I'll come back to you. The question to you is, are you hurting from recency bias? But for you first.
See, I think this comment should be made 1 year back, not today, that gold is a growth asset class. After it goes up 100%, it is recency bias.
Growth asset class doesn't mean, doesn't stop with 1 year, right?
Who knows? So do you have a framework to say that 1 year later it will be higher or lower? On what basis? See, today I think everyone is talking that central banks are buying, but they've been buying for 4 years. Why 1 year back no one spoke about it? There was enough data available. 1 year back there was data available. We published in DSP Netra that 24 out of 25 emerging market countries, gold had beaten equity. And the only market where gold had not beaten equity was India, where Nifty was marginally ahead. This year even that gap has been erased. But it is wrong to make conclusions after an asset class where the long-term median returns are only 10 or 11%, when that has gone up 100% in a single year. It means it has given 10 times of its core return in a single year. All 10-year, 20-year data points will look biased. So there is an endpoint bias right now. And that's why looking at median returns is very important. Of course, no one can predict 1 year later gold can still do another 100%. Who knows? If I knew I would have 100% in gold, I have only 15 right now. But the point I'm making is, we are also chasing asset classes. The narratives are also basis, what is very popular today. And then we are no different on this stage than, the common consumer to whom we are teaching and preaching. I feel at all points in time, a balanced asset allocation, personalized to each investor is important. My son has 100% in equity. I have 65% in equity. Each person decides what is his appetite and what will help him stay invested for very long periods of time. Should be the starting point, not what I feel is right, because what I feel is not right for everybody, number one. Number two, where are you in the cycle? Small cap funds, people are, redeeming right now because they were told that there is growth, there is energy, there is speed, everything is fine, 20% CAGR. But again, the long-term median returns are only 14-15%. So when some asset class runs ahead of its core return, you have to flag off. And you have to bring prudence. And the best time for prudence is at the peak of the market, not at the bottom of the market. And the best time for being excited about equities is when NAVs are lower. Right now, nothing is lower. We still are at all-time high. Nifty is at what? I was just seeing 0.9% lower than its all-time high in September. So where is the correction? Now, individual portfolios are bleeding, but they deserve to be bleeding because people didn't. I know so many people who don't know the ROE of a company and have bought, 80% of the portfolio is in random small cap stocks. So that is part of every 5-year cycle. Nothing is new in what we are discussing.
No.
And we need to
no,
build
true
discipline.
that. But this point, I want a little more conversation around that. So, Swaroop, the same point that I wanted to ask you, I think Alpin articulated better, that 1 year has made up for the previous 10-year returns.
25 years, actually.
Is it?
Yeah.
Okay.
25 years.
25 years. So, is there bias in that? When you look at it at the end of 2025.
Okay, let me make some personal disclosure, and mutual fund guys always come with disclosures. There is no investor meet that I do for the last 25 years without a reference to gold. Primarily because of the fact that it is an asset class closest to every human being.
So 24 years, you were not that right.
No, I'll tell you, I'm coming to that.
Were you?
2 years ago, I had a good blatant call on gold, which got enhanced when US elections changed. I got so excited that my call was going right that it did not have a portfolio impact, to be very honest. But I didn't miss out on the silver call. And that has impacted the portfolio very well. But forget returns. I mean, we trivialize everything when the word returns comes in. This is asset allocation. If you look at the asset allocation wheel shared by RBI on financial assets, today an average Indian invests 30% of his or her money in bank FDs, 32% in gold. Only 10% of their money comes in equity. If you want to get the real asset allocation of the wallet share of the person, we have to go to an asset class which he or she is comfortable with. Not, and out of that 10%, blatantly 45% goes into small cap over the last 2 years. Problem was not with small caps. Problem was 45% sales in small cap. That's the issue. So if the industry has to grow, my personal opinion is we have to go to them. And the most comfortable asset class remains gold. Please understand, we historically have bought gold every year on the worst day of gold, that is Dhanteras, without blinking on the price discussion.
Yeah.
That is they buy that. Now the problem is we Gyanis, when we get them to the financial side, we will discuss returns with them. And that's why probably they'll not invest with us. But traditionally, since my grandmother or great-grandmother, the brilliance of these erstwhile financial advisors had given us that date, that buy gold on Dhanteras. It's the worst possible day because the demand is highest. We've not thought of price. You tell anybody, boss, don't buy on Dhanteras, buy in the next month, they will say, boss, kya baat kar raha hai yaar? अब शकुन हो जाएगा. Right? But if we keep it that way, and fortunately for us, and Kalpan and I were on a panel recently, my observation is the Gold Council goes out and puts hoarding for the last 2 years on Dhanteras Day and gold ETFs. Mutual funds are yet to have the courage. I will put courage as a part to advertise gold ETFs in that meaningful manner. The Gold Council thinks it better for us. That's the reality. My point is, it's an asset class which everybody is comfortable with. Equity at 10% is still not an asset class which people are comfortable with. If you want to grow, that's the asset class, my opinion. And I'm making full, you can check any of my things.
Oh my God, I have so many questions to ask you. But Sid, what is the category or product or a segment that you're really excited about for 2026 for Geo BlackRock? What is going to dominate conversation in 2026? The way you interact with investors, distributors, create your own, roll out your products. What would you prioritize?
I'd like, given that we're still in very much a initial growth phase, I'd like it not to be just one product. I'd like it to be many, many, many products next year. But I think, and there's a reason for that. And I'll go back to the first answer, right, which is about the fact that we truly, truly, truly believe that this is an asset allocation story. So we need to have the right building blocks. We need to have the core exposures. So we're working very hard on those, even within core. And I would still be in the camp of, let's say, equities and flexi-cap being more of a core than gold. I think gold does have a very significant role to play. And especially given kind of some of the geopolitical as well as the trade tensions, I think there's more of a room to go there for this year for sure, but I'm still not replacing it as a core exposure. But having all of these building blocks at play is key. And then when you think about, for let's say the investors who want a bit more, because again it's all about personal choice, so what does the individual want, and they start looking at satellite exposures, really thinking about what are the differentiated ways in which we can provide exposures to different parts of the market, right? And I recognize that we're one of over 50 AMCs. A lot of them already have a lot of funds here. So for us, it's always about how do we bring new ideas to the market, different ways of investing. We did that a little bit with our FlexiCap fund by using data, AI-driven investing. We're going to be doing more of that. So rather than any single fund, I would call out the fact that we want to be launching a suite of products, suite of funds that bring differentiated exposures to the market. That's how I'm looking at next year.
Kalpen, your focus will be on international equities through Gift City?
No, so Gift City is one new strategy that we have launched because we've been working on Gift City for the last 3.5, 4 years. Probably we are the largest fund house on Gift City. May not be so in India, but because we have a lot of global capital. And under the LRS window, we launched the first retail international fund. Also because we believe that some of the best business models of the world are available at fair price, or lesser than fair price in different parts of the world. India in the last 5 years, because of more flows chasing less stocks, there is some bit of froth. That froth has started normalizing, but maybe some more time to go. So it's good to have a balance. So personally, I feel that the best way to invest is to buy good companies at good price, independent of geography. You get some in India, build that. You get some rest of the world, build that. So that's the combination we would love to offer. And at the same time, so I think about it this way, that our primary focus will continue to be hybrid funds, especially multi-asset funds, where 2/3 of the portfolio is in growth, which is stocks of India and the world, and 1/3 of the portfolio is in a way, anti-growth, which is gold, silver, and bonds. We are still at a juncture. And like Swaroop mentioned, ironically, last year, all asset classes have risen. So the low correlation also has broken away. So in that sense, we are in uncharted territory. It's very difficult to call out any one area. At least I feel it's better to be slightly more diversified. Stocks are still expensive. Gold also has become expensive. We have some, framework that we look at, money supply to gold, money supply to silver. It has also come closer to its top band of fair value. But there are uncharted territories in how US is behaving, how trade wars will play out, how the overall deflation cycle could play out. And there could be periods where gold could correct as well, or it could go up. I don't have an answer on how the direction will be, and which is why broad-based. When you don't have an answer, I look at it this way, that I am less confident. And when I'm less confident, I will diversify.
Fair enough. Sid, will you come up with your products out of the Gift City? Are you thinking about it?
Yeah, absolutely. We're looking at that as well. So, like I said, as allocation is a story, this is a real diversifier. And again, we, as one of our sponsors, BlackRock, have the ability to offer very differentiated products to the market here. So looking at that, and again, I think the key is the how, right? I think the what we kind of have figured out because we've got the underlying funds at BlackRock already. But it's about the how. I think, like LRS, there is a lot of frictions, that you can still get it done, but it's still frictional. So us being a digital-first asset manager, we're really looking at how can we get the digital ecosystem to a place where we can remove those frictions. And I think that will be the biggest enabler for providing access to those exposures. And I think that will be the game changer.
How friction-free is Gift City?
Not yet, because you have to first transfer money from your India bank account to Gift City. You have to instruct the bank to transfer it using that A2 form, and even the CAMS ecosystem is not yet ready. Today, if I want to know the NAV disclosures on the app are still not integrated through APIs.
Right.
Redemption APIs are still not in place. So there's reasonable amount of friction, and I wish they were first and they would have sorted it by now. Then we could have, played on the guardrails they have created. But there's a lot of learning curve. Everyone is working hard. Hopefully in the next 3 to 6 months, it will become completely friction-free. Lastly, even today, you have to fill up a form. It's not completely digitized yet. Yeah. And also, one thing, while I'm very excited about our LRS fund, but I'll also highlight that investors should also ask their bankers for better currency rates, because the currency transfers typically tend to happen at 1.5%. And assume if it happens on both the sides, whatever alpha you would get. So it's very important to educate people. So there is, of course, glamour of global investing because of last 5-year returns. But I always feel also show the other side of the coin of what are the other risks that you should be aware of.
So do you think this international investing out of the Gift City will become friction-free at all? Because there is a reason why that window of opportunity to invest international markets for global investors is shut, right? There is a reason for that.
See, I'm not the right person to comment on the reason.
No, as an industry voice, what do you think?
Ideally, an investor should be allowed to invest, right?
The question is, do you think it will become friction-free?
No, I don't think so. Looking at the environment, just being honest, I'm just hopeful that all of us on the international side in Gift City keep it a little low-key so that we don't catch attention. But thankfully, the flow of funds is not that great on the Gift City side. Still early days because the backend is getting created. Once the backend is created, and I hope that is taken more seriously, there's a lot of scope on the LRS side that can be really dug into. And from a portfolio allocation perspective, it's absolutely essential to be there. If you're not there, it's your problem. With all humility, this product of mine, and please, I'm not selling a product at all. This product called Fang Plus has unlearned everything inside me. Right? I still do not know why people buy that product at 9, 10 to 22% premium in the market.
Yeah.
But people buy it. And for the last 3 years, they've been right. I've been wrong. I've been sending letters, don't buy. But they are buying. Somebody wrote back saying that you can say there's a premium, but don't say don't buy. Right? This complete universe is moving from what we call risk-averse investors to risk-seeking investors. And that's where, the game really changes. And spaces like Gift City play a very, very important part. But from an ecosystem, let me point out something. How many accredited investors in India? Hardly. Last time I was in SEBI, I was told 644.
Yeah.
Now, if I am an accredited investor, those thresholds don't matter to me. What's stopping the ecosystem in building accredited investors, right? There's a bias to not building it, but if you are an accredited investor, all these things of Gift City can become a little more seamless for you. But a lot has to happen on the ecosystem for it to build, but it's early days. But I see that single regulator to be very powerful in coming times.
Yeah. Kalpin, you want to add something?
I think while currently there is friction, but I'm hopeful because we engage a lot with the IFSC team and they are working very hard to solve these things real time. And one lens through which I think they are also looking at is while Gift City's original purpose is to attract global capital into India, and which we are all solving for. But with so many of us now offering investment management on global stocks. This is also trying to capture the global profit pools.
Yeah.
So a lot of NRI money, which is investing in global asset managers for their global stock portfolio, why can't we manage it out of GIFT City? So I think at some point, regulators do see that also as an opportunity, that how can we get other countries' capital, even if it is invested in global stocks, but the manufacturing is shifting here. We want to export in so many industries. This is in a way exporting in our asset management industry. And I do feel that I would be hopeful that things will become far more seamless and positive.
Sure. Swaroop, your priority for the year?
No, I think priorities, I think I'm very fortunate to be an asset manager sitting here in the country today. It's a brilliant time to be an asset manager. Thankfully, we don't have to choose products for the investor, right? Our job is to create products. And in the 18 years in India, please check our commentary. We've never given a product-specific commentary. Our job is to build track record on the all the products that we bring, and we'll continue doing that. Yes, we see a lot of change in the underlying demography of investors coming in, and we have to cater to the young. So some of the products that will come from our side could be higher up on the risk profile, and will cater to people who understand and are quite comfortable with that risk. And I dare say, I see that part of the investment universe to be growing, right? I don't think my son will put FlexiCap as the core of his portfolio, and I see the number of investors in his age group growing for our industry. Unless we cater to them, there's Bitcoin for them, is my opinion. So if you want to get them from there to us, we have to cater to products which will satisfy their, and it's not about instant gratification. They are fairly knowledgeable, they know what they do. And they can bear risk far higher than what we did. And that's where 2025 is sitting. So across board, whether it's equity active, equity passive, debt active, debt passive, GIFT City, SIF, maybe we'll talk about our venture capital fund next year. We do have a fair size there. So as an asset manager, and please understand, the regulator wants the SIF from our platform. Could not be a bigger certificate for what we stand for on transparency and efficiency and the way we manage people's money, right? That's a huge tick off if you ask me. So when you look at that regulatory backing to you, you go out fearless and create more products for people, right? And it's very fortunate to be sitting on a chair like this at this moment in this country and catering a fiduciary role. No better job than this on earth, I feel.
On that optimistic note, that's all we have time for. Thank you so much, gentlemen, for this wonderful discussion.
Thank you.
Thank you all for that discussion on industry evolution and strategic positioning. And thanks once again, ML. Long-short equity is one of the most debated strategies this year. With SEBI's approval of the specialized investment fund structure, fund houses can now offer schemes with up to 25% unhedged short exposure. But India's market with high stock borrow costs, concentrated liquidity, and shallow depth makes scaling challenging. The question is whether long-short can succeed here and if investors understand the trade-offs: smoother volatility, moderated returns, and higher costs. To have this discussion, let me invite on stage Gaurav Mehta, Head SIF Equity SBI Mutual Fund, Bhavesh Jain, Co-Head Factor Investing Edelweiss Asset Management, and Sandeep Tandon, Founder at Quant Group. Good evening, gentlemen. Hope you're having a great evening. Interesting topic, and of course, it has been the talk of town. Long-short funds, SIFs, all you hear about is these funds. But the question we are asking today is whether these strategy can deliver alpha in India's ever-evolving market landscape, or is the excitement really running ahead of reality? Let me start with you, Sandeep. Of course, long-short, what sets long-short apart is the fact that you have a 25% short exposure limit. How is it really being viewed by investors? Is it being viewed as a risk, or is it being viewed as an opportunity?
So let me start with saying that the product obviously is very new for India. I think it's about education and the mindset. The moment we talk about shorting, the shorting is linked with, as a mindset, with the hedging. Nobody thinks about shorting for an alpha creation. That is the first differentiation, that we have to think that by shorting also you can create an alpha. And that understanding is still missing in most of the people. I'm not saying all, but obviously lot of HNI family office who trade for the short positions, they want to generate alpha. So they have understanding. But this whole thesis, we have to explain what is unique about this product is that first time SEBI is giving opportunity to generate superior risk-adjusted return. It's a great beta management product. We have grown with this thesis of generating certain expectation, and everybody talks about returns, relative return, absolute return. Very limited people talk about risk-adjusted return. So I think this product will educate us about the risk-adjusted return, and you can generate actually alpha out of it if you remain patient investor, because shorting is very different phenomenon. I'll just give you a small example. When we started this product very recently, the mindset in the team is they're used to have losses when you have a long position, buy on dip sort of. The mindset is that when you have a small hit, you're okay. When you short, you don't have the mindset to lose money. Okay, I'm just trying to give you a behavior perspective. Nobody looks short as a hedging instrument or as some sort of insurance. It's a alpha creation thought process there. We cannot lose money on the shorting side. That's the mindset. Once we start accepting that you can also lose money on shorting if you can bring down your risk, the risk assessment is something which is very important, and the first time we are experiencing as an industry. And I think this product has long way to go, because we are living in a very difficult world. Okay, from a geopolitical perspective, I always talk about that easy phase of bull run is over. And in difficult phase of bull run, these types of product, long short product, will give you far better risk-adjusted opportunity.
Sure, let's delve into strategies, because as you mentioned, it's a very difficult product to really understand. And, of course, a lot of education is also required for that. But, SBI has also, I think, launched a hybrid long short fund, right? What has the response been like, both in terms of investors and distributors? Take us to that, and also tell us more about the strategy that you guys are adopting at SBI Mutual.
Right. So I think, first of all, when you think of SIS, and I think Sandeep already talked about it, when you look at a conventional mutual fund, it largely tends to be a beta product, which is that it is exposed to how the underlying asset does well. And if the underlying asset does well, the product does well. Obviously, there is an element of alpha, but that usually tends to be much smaller compared to the beta that the asset class performance leads to the fund itself doing well. I think SIS in that sense are a little different. You can short. You can therefore create risk-reward propositions which are not directly linked to market direction. You can benefit from a market decline as well. And that in turn means that, the conventional risk-reward spectrum that long-only products used to fulfill, there were several gaps, and those gaps can now be fulfilled through SIFs. And I think in that context, our endeavor was to look at the biggest gap in there. And I think, all of us here would agree that for the last 2.5 years, one big challenge has been that debt taxation changed. And to that extent, getting relatively low risk returns with tax efficiency has been a big challenge. And which is why you've seen so much of money go into arbitrage funds. They are just ballooning by the day, even though the returns there tend to be very modest. But because there is tax efficiency, because there is stability, people still want to go into arbitrage and just let that money be. And then, on the other hand of the spectrum, on the conventional mutual fund platform, there are funds like hybrid funds, things like balanced advantage and multi-asset and so on, where you reduce equity exposure to some extent, but not completely. You're still exposed to equity to some extent. And this, we thought, was proving to be a big leap for investors to make, right? Moving from the safety of arbitrage, but low returns, to something like hybrid funds on the mutual fund platform, which can offer better returns, but still carry some unhedged equity risk. I think that was proving to be a big step. So our idea was that let's bridge this gap first, and which is why we started at hybrid long short as a category. And our idea was very simple, that if while adding some variability to arbitrage returns, but not as much variability as comes from conventional hybrid funds on the mutual fund platform. If you can create a return proposition which is, a respectable few percentage points higher than arbitrage, then, that will be fulfilling, this big vacuum or demand from investors that has existed for the last 2.5 years, which is in a way saying that, can you achieve debt plus returns with equity taxation, with some variability in returns, but not a whole lot. And I think, which is why, we thought that this was a good space to begin because that's where the biggest vacuum is. And, which is what we do. We sort of achieve equity taxation because we carry 65% exposure to equities. But at the same time, the difference between mutual funds and SIFs is that your ability to use derivatives is significantly enhanced here. So you can use option strategies and so on to manage your variability, manage your risk profile, even though you carry 65% exposure to equities. And that's been our intent. And I think the reception, it's still early days, but it's been pretty good so far. I think the key challenge today that exists in the industry is that you're still in early stages and there is a derivatives examination that distributors need to clear in order to distribute these products. And I think that number still is very insignificant because, I think it's true with all exams, right? Till the 11th hour, you don't want to begin preparing for an exam. So I think now that some of us have already launched SIF products, I think the distribution channel is also warming up to the concept. They're also clearing examinations. And, since we launched about 2 or more like 1.5, 2 months back, there's already been a significant increase in the number of, people registered to sell this product. And I think it's still very early days, but so far so good.
Okay, so far so good. But, just want to understand hybrid equity. I mean, what is the allocation strategy there?
Right. So in our product, we would allocate 65 to 75% to equity. You need that to get equity taxation. The only, from a regulator point of view, the only, if you were to think of definition of hybrid long-short category, you are largely allowed to invest between equity and debt as 2 primary asset classes. And you have to have minimum 25% in each of them.
Okay.
So to achieve equity taxation, equity for us is closer to the upper end, 65 to 75. Debt for us is 25 to 35. And up to 10% leeway we've allowed for REITs and InvITs.
Well, yeah.
But again, just to clarify here, when I say 65 to 75% to exposure, this is not complete uncovered exposure exposed to all the vagaries of the market. We use option strategies like selling call options to earn some premium, using that premium to fund the purchase of put options to protect ourselves from the downside. And we use these strategies on almost all of the equity portfolio such that it's not exposed to infinite risk if the risk even materializes. So to that extent, this product is still correlated to the market, but the beta or the sensitivity to overall market moves is extremely low.
Coming to you, Bhavesh, Edelweiss as well, what are you doing differently? What are the strategies you guys are adopting at your fund? And what is the kind of response you've got so far?
Sure, I think as Swaroop mentioned in the previous session that we don't have to select the product for the client. We just have to build a track record. And I think at Edelweiss, we always had that philosophy that hybrid fund is totally different from long equity piece. And that's why normally you will see each AMC have one equity CIO and one fixed income CIO. But here we have 3 different teams. And the team which I am, you can say, part of or co-heading is, you can say, hybrid products. So having that experience of managing arbitrage fund, balanced advantage fund, multi-asset fund, equity saving fund, we thought that now if we are able to run a product which will in a way enhance our return without adding meaningful risk by using some of the derivative strategies which were not allowed to mutual fund. And if we are able to deliver arbitrage plus 3% kind of return, that will be a great achievement. And to get that, we are not even, you can say, using derivative to make money by going short on market. We are just using option writing, which in mutual fund is allowed only to a limited extent. Covered call only in Nifty 50 stocks. Here there is no such restriction. So doing covered call, doing covered put, if we are able to generate that extra return, it is like an arbitrage plus strategy. So we are doing a lot of debt, a lot of arbitrage, and then all the special situation available in market, whether it is IPO, open offer, merger, demerger. Because see, finally the end goal is to make 2.5%, 3% above arbitrage. Part of that will come because of higher allocation to, you can say, duration, higher allocation to some credit. A part of that will come because we are not selling futures, we are selling options. And then a part of that will come from special situations. It is not that in mutual fund you are not allowed to do all special situation, but when it comes to arbitrage, you are not allowed to do a merger trade or an IPO. But now in SIF, you are allowed to do all that things. So that is where we thought that because this is something totally new for the market, new for us, new for the regulator, why don't we play with our strength? Our strength always have been the hybrid products, and that is why we went ahead and launched this product, the first one. Both things, one, it was playing to our strength. Second, as Gaurav rightly mentioned, the biggest gap we today see is for a fixed income investor. Earlier you used to invest in fixed income mutual fund, taxation has gone for a toss. Arbitrage still doing better than liquid, but absolute return have come down because of this interest rate cut. And then all your hybrid products like equity saving fund, balance advantage fund, they come with their own equity volatility. We have seen during COVID, a lot of equity saving fund and balance advantage fund have delivered return of anywhere between -10 to -30. So purely a fixed income investor cannot directly move to even a hybrid fund. That is where I think this is the gap we wanted to fulfill. And SIF with, you can say, higher utilization of derivatives, which is not allowed in mutual fund, is the product which can deliver that, you can say, in a way, not risk-free, but with very little volatility. So again, 2 months is a very small period, but if I look at last 2 months of our performance, our portfolio beta is 0.08. Our standard deviation is less than 2. So a product which is able to deliver arbitrage plus 2 to 3% return with this kind of beta and this kind of volatility, definitely it is a scalable opportunity for us.
Sandeep, what do you think? You guys have just launched QSIF X100, right? So that excludes top 100 companies in terms of market capitalization. Do you think this is an impediment, or I mean, how are you approaching it?
See, let's understand, when we talk about long-short strategy, globally these are known as wealth preservation strategies. So, see, the challenge for equity market is about beta. So, everybody loves mid and small cap returns. When the downtrend comes because of high beta, they correct sharply. Okay. So when we're talking about SMIT portfolio, obviously in the mutual fund A, the SMIT portfolio is not allowed. A combination of mid and small put together, which is the case regulator has allowed us. Now the edge is that how you use this product. We are launching these products on relative to mid and small. This is not a category which you look at in isolation. We are very clearly saying mid and small along with this. So we are talking about 25% shorting opportunity along with mid and small opportunity. So it's a better beta management product on the SMIT side. So obviously if market rallies and you can participate, there's no restriction that you have to run long short on continuous basis. Okay, there's no such restriction from, we can even run 100% long. There's no restriction on that. But if you believe that it's a risk off period and market can correct, then you have opportunity to short the mid and small basket. So very important for us to understand mid and small in the SMIT category, you can only short in the SMIT space. You cannot short through large cap, where in the equity long short, we have a flexibility to short anything. So it's an opportunity. So we are very clearly saying that, let's say first we're talking about equity long short product. So we are saying it's managing like a flexi cap plus something. Okay, it can be marginal negative returns also. It's not possible all the time. But what is the endeavor? Endeavor is to generate alpha over above that. So we believe in a difficult risk-off environment, equity long-short product will generate flexi cap plus return. Similarly, SMIT will generate a mid and small plus return. And obviously, if you can cut down the beta significantly, then it's a great product. Okay, so we have to understand, and timing can't be better than that. Okay, because you look at last 1 year, market has corrected, consolidated, mid and small has corrected, liquidity is also being a big challenge in some of these places. So it's a unique opportunity that market has gone through a phase where people have understood the importance of shorting or importance of managing beta in an effective manner. So it's easy to sell and easy to convince people that this is a unique opportunity is there. We as a house are very optimistic, so that so far we have only seen one way of looking at generating alpha. This is the first time such products are coming. The only differentiation is that a lot of people come and ask this question, why the schemes are underperforming, okay? So they don't want to have underperformance also when market is rallying. So you have to be very clear on relative basis. If you're on a raging bull run, these products will underperform because you have element of short, and some people will do it. But if you are in a volatile market, downtrend market, or difficult phase of market, where the market is not going anywhere, these sort of strategies will generate alpha. So it will generate alpha over your benchmark also. That's the way the strength of a money manager comes, how well you can play on the inflection point by looking for a shorting opportunity. See, what is very important in this product, when you talk about short, you cannot do it from long term. You could have never heard somebody saying, I'm rolling my long position. You have heard. Nobody have heard that I'm rolling my position for last 6 months short position. Very rarely you hear that phenomena. Okay, and hence the entire focus of this product, we are saying opportunistic short and tactical longs. So we are talking about purely an opportunist based thing. I am not running a product which is that round the clock I am running a long short. Globally, people have failed. When you are running long short products simultaneously, you can go wrong on both the side. When we are talking about opportunity short means when we are seeing a data points based on our analytics skill set, we can look for shorting opportunity, and these are short-term trades. So our entire investment horizon in this product is near-term and medium-term. We are not looking for anything from 5-year perspective, 3 years perspective. It is because if you have to manage your risk, you cannot manage risk for next 3 years and 5-year perspective. Risk management can be done only from a quarter or two perspective. That's the best you can do. And hence, we have to understand this entire thesis of risk management. And that's one change I think one has to really look about. And most important is the tax efficiency. If people sitting in this room are HNI and trading in the market, they know what sort of tax they pay. 27.5 for the company and 47.5 for the individual. And then you are on accrual basis, you have to, when you generate profit, you have to pay those taxes, okay? Either through advanced tax route or with the interest. Here the advantage is that if I do 5,000 trades in a year, and generate better return, there is absolutely no tax unless you withdraw money after 1 year, 2 years, then you have to pay long term. So it's a phenomenal tax efficient product and which can protect your downside also.
So what is the kind of investor who should invest in this? Should the traditional HNIs invest, or should more sophisticated ones look at it as a tactical play?
No, I will say it's meant for everybody. The way we are positioning this product, a lot of people get confused. We also get calls from a mutual fund side, whether I should switch or should I prune down my exposure and then participate. It's a very simple answer. If you look at a combination approach of a mutual fund along with this thing, then the combined portfolio reflects lower volatility, lesser drawdowns, and better alpha generation strategy can be there. And what is very important to understand, this product actually is meant for more conservative people. Okay, it's not meant for aggressive. Entire industry has demonstrated that we are moving towards conservative approach. So this product is actually more apt who is more conservative from the equity perspective as well as on the debt side also. So it is actually a better
product. So even
product.
retirees can invest? Even retirees
yes,
can
of course.
invest? Okay.
See, you have to understand the risk what you are taking. Okay, if you ask me, let's say our equity long short versus flexi cap, our own fund, forget the industry. Definitely, this is a better product from a risk adjusted return. Very clearly, you have to look at, you have to be clear in a raging bull run, this will underperform my flexi cap. But in a difficult phase, it will outperform. So, and I'm comparing only with a relative basis, not an absolute basis. Once you are clear on relative basis, this is the way it will perform. And we are clearly looking at next 5 years will be very challenging. Last 5 years has been extraordinary, right? From 2020 till 2024, okay, has been good, or let's say January 2025. Now, if we believe it is going to be challenging environment, then this is a great opportunity. We can protect your wealth in a big way. The challenge, let's say, small cap and mid cap is all about that. And if we can offer this product where my volatility is on the lower side, I'm able to showcase lesser drawdowns, and able to outperform the market, not only the benchmark. And I think it's a unique way of looking at in this sort of product.
Sure. Gaurav, coming to you. This is a hard product to understand. I mean, that's something that we have established already. So what further needs to be done to really educate investors about, long short funds so that, they can beat the market at a time when the conditions or when the, cycle isn't looking all that encouraging. So what more needs to be done to educate investors, even distributors, so to say, when it comes to long short funds?
Right. So I think, I think the regulator has done the right thing by making that derivatives exam compulsory for distributors to sell. Because once you take that exam, you already gain some basic understanding of how derivatives work. And then it's easy for you to place, the context of the product with the context of the client's risk and return objectives. Secondly, I think the regulator has also said that have a separate branding here, right? Don't use your conventional AMC name. Have a separate branding. For example, in our case, we call it Magnum SIF offered by SBI Mutual Fund. And that also, in a way, sort of conveys to the investor that there is a different proposition here versus a conventional long-only mutual fund. And maybe I need to understand that better before investing, unlike, a conventional mutual fund. But beyond that, and I think, the bigger challenge here, and I think if you would have heard all of us speak, is that, derivatives can be used. I mean, there are options, for example, are nonlinear instruments, right? For someone can use options to enhance risk, someone can use it to mitigate risk, someone can use it to express a volatility view, someone can use it to express a directional view. And to that extent, I think the packaging that can be done through use of derivatives with conventional asset classes can create risk-reward propositions which are extremely different, right? So in the same category of funds, they can have a product, and I can have a product, all of which look very different from a risk-reward positioning point of view. So I think that increases the complexity both for investors as well as for distributors to understand what exactly is this product, what is the risk-reward positioning, and so on. But I think, all of us will have to spend more time communicating better during product launches, after product launches, during our sort of monthly communiques and so on, to make sure that investors are aligned to what the risk return objective of their product is. Because eventually whatever is the strategy that you use around options, futures, all of that, it all boils down to whether it's being used to mitigate risk or enhance risk. And hence, correspondingly, what is the risk-reward objective? To the extent that you can make both distributors and investors well aware of what to expect in different market circumstances on those two objectives, I think your job is more or less done. And then, again, one other factor that works so far against this this sort of class of funds is that, it's only 2 months old. So I think as slowly track record builds up and people see the actual performance in different market phases, that in itself will also instill confidence.
Sure. Bhavesh, coming to you, what according to you measures the success of a long short fund? Sandeep mentioned risk-adjusted returns, low volatility, tax advantage. What according to you is something that one should look at while determining the success of a long short fund in India?
I think, success of any product will depend on what we are trying to achieve, because as Gaurav mentioned, all three of us have hybrid long short fund, but totally different from each other. That's why success for every one of us will be different. For us, I think the most important thing will be whatever we are setting as a benchmark for us, whether we are able to beat that benchmark consistently or not. Like in our case, we want to run an absolute return fund kind of strategy. So number of negative quarters, number of negative month, this is something which we will evaluate very closely. And again, success, if you will see, the first arbitrage fund got launched in 2004. From 2004 till 2014, the total aim of the industry was just 5,000 crore. And when tax changes happened, from 2014 to 2024, the category is more than 3 lakh crore. So obviously, any product, first, arbitrage also complex where it was, we can say, becoming more and more popular. But entire industry put in a lot of effort to make people understand the risk, return, profile, what is the expectation and what is the returns you wanted to prove. And after, you can say, few months, few quarters of track record, the category now is one of the fastest growing category. I think same thing will happen over here. It is still early days. There are a lot of apprehension from, you can say, as a manufacturer from us. We are being very conservative. From distributor, they are not in any hurry to clear that exam and push those products. And from client point of view also, market anyways have not done, you can say, anything great over last, or you can say 12 to 15 months. So they are also not in any hurry to try anything new. But if you see in our NFO, we collected close to 300 crore. Today, as we speak, we are more than 900 crore. So 3x in less than 2 months, according to me, that is also success. Because that first mover advantage for what we were fighting for, we are seeing that fruits. But again, till the time the entire industry doesn't come up together, we don't see at least 10, 12, and particularly few larger AMCs launch the product, I think it will be a slow-moving category.
Sure. I know we're running out of time, but one last question to you, Sandeep. Given how manager skill and execution discipline can make or break outcomes, all three of you all have hybrid funds as well, right? So should investors really brace for a wide dispersion in returns between managers? And what is a reasonable return expectation according to you?
So, as we were discussing, that all three products are different. Okay, so investor also has to understand what type of investment strategy he or she is putting that money. That's the first more thing, and obviously the return expectation should be linked with that. Okay, all three strategies are different, and I think it's a very early stage. It's just evolving. How mutual fund we have seen from UTI days evolved today is such a large industry, and he was also talking about how the arbitrage opportunity from 5,000 to 3 lakh crore. I think the way we look at is a very early stages. What is required from the industry perspective is all about education. In fact, if you look at, we have already started the education campaign on educating about why SIF is important. SIF is zaruri hai, okay? It's a very vital piece for, along with the mutual fund it's important, but this piece is also very important. Once this concept is absorbed by the people, I think you will see very different growth. It might take 3 years, but after 3 years, I think exponential growth.
You've been working on long short long before you launched your fund.
We used to run a very large prop book within the quant.
So, and it didn't do all that well.
No, it went very well.
It did?
So, I'll give you 10 years we ran that prop from 2008 till 2018. Not a single year we lost money. Not a single quarter we have given negative returns as a combined strategy. So, and it's a large prop. We used to do $1 billion, $1.5 billion turnover on daily basis. That's the size we operated. So, we are very happy with that track record which we had. And it's a mindset game. Okay. The challenge with the industry is right now, 99.9% people are used to one direction. They have never thought of other side. So, it will evolve. So, today we have issues in terms of manpower hiring, but I think it's the next 3-5 years, we have a very good young generation. And we are seeing young generation sitting people on the dice.
Sure, of course. On that note, of course, we have come to the end of this discussion. I have so many more questions, paucity of time, but thanks a lot for taking our time, joining me this evening. And
Thank you.
Thank you
so much.
Well. Thank you. Well, before we draw the curtains on this inspiring evening, may I please invite Nalin Mehta, Managing Editor, Moneycontrol, and Chief AI Officer, Editorial Operations Network 18, for the closing address.
Thanks very much, Nandita. And firstly, my apologies, everyone, for missing the first part of this evening. The Delhi smog and fog put paid to the best hopes of mice and men. So with all the flights in disarray this morning, I think it's ironic that on a day on which we've been debating making wealth or wealth creation in an uncertain world, at least a very small measure of some of that uncertainty that surrounds us around climate risk, regulation, and the wider environment around us, it kind of hit some parts of this event as well with flights. And most of our event organizing team today, by the way, is still on flight and still hasn't made it to Bombay. So it's kind of a reflection of the uncertainty around our times in a very small way. And we've had a very thought-provoking evening with so many leaders from across investing, policy, business, and capital allocation here this evening, talking aloud about the big picture of the issues that animate us around the Indian markets. If I were to sum up some of the key strands and the takeaways from these discussions, the first one I would say would be look beyond the last year. As Aparna Karnik said, short-term underperformance can be misleading, though Indian equities have still delivered strong returns over the last 5 to 10 years. Number two, valuation worries are real. As Siddharth Daya, among others, cautioned, many stocks look overheated beneath headline index numbers. Number three, diversification is key. As Saurabh Mukherjee and Abhishek Tiwari pointed out and cautioned us, spreading investments across asset classes and global markets is essential. Number four, be selective going forward. It's a theme that kind of ran across all sessions, as I understand. Returns are likely to come from specific sectors and stocks rather than broad market rallies. Fifth, SIPs could be moderated. Chirag Setalwag, for example, pointed out the most structural challenges of India's emerging young investor base, of people who are investing who haven't seen lows before. And that brings a different kind of challenge for investors and for expectations around the stock markets. Now, at a time when caution seems to be the overriding master theme, another key takeaway, of course, is that don't chase fads and look at long-term value. I think it would be fair to say that we are living through a period where uncertainty is no longer an exception. It is the operating environment. So amid this message of caution, may I add 3 quick points. First, history tells us that wealth has always been created in uncertain times, not in spite of them, but because of how investors respond to them. Second, India today sits at a fascinating intersection. As Mahalakshmi, my colleague, always points out to me, never before have Indian investors have had so many opportunities with so many products and with so much access to capital markets. I think we shouldn't forget that. It's worth reminding ourselves that India has over 21 crore demat accounts, as Bodhi also pointed out. That's more than the populations of countries like Mexico, Russia, Japan, or the Philippines. This means about 13.6 crore individual unique investors. And overall, India's equity market capitalization has crossed $5.29 trillion, which makes us the 5th largest in the world and about 4% of the global market cap. As we move towards becoming the 3rd largest economy in the world, certainly well before the end of this decade. These are not just big numbers, they also reflect something more important. For the first time, domestic capital is shaping market outcomes in a meaningful way. Retail investors, SIP flows, pension and insurance money are no longer just riding the market, they're also helping to stabilize it. This has changed how volatility plays out and how risk is absorbed, even when global capital remains fairly cautious. The Indian market today, therefore, is more deeper and more resilient, but it is also much more demanding, and for most people in this room, for example. And as we move away from easy, broad-based rallies to a market that rewards selectivity, patience, and judgment. So this is why I think today's conversation becomes even more important, because this is not just about investing. The pool of savings ultimately powers India's real wealth creators, our businesses. It fuels expansion, innovation, and job creation, all of which are absolutely central to the idea of a Viksit Bharat by 2047. This is why we at Moneycontrol curated this summit. As India's largest financial platform, at Moneycontrol, our role is to help investors cut through the noise so that they can make more informed decisions, deploy capital wisely, and build resilient personal wealth. And when investors do well, the nation does well. Uncertainty makes clarity, discipline, and conviction far more valuable. So to all of you who spent your valuable time with us today, I hope you found some of the answers to the big questions of our times in today's sessions, and hopefully key takeaways that are more directly relevant to your work. But this is, I think, only the beginning of a long conversation. So a big thank you to our partners Dezerv, Sandeep Jetwani, Sahil Contractor, Weber Porwala here. I think we definitely deserve to do much more interesting things together as we go along. Thank you very much, ladies and gentlemen. Please join us for drinks and dinner outside. Thanks.